Good evening and welcome to all to this webinar on issues in tax GST input tax credit by CAS Venkatramani from Bangalore. And I request the chairman who is on the move, but still for the moment he is stalled at a place. Happy to see you, chairman, and I request you to propose a formal welcome speech.
Yes, sir. Yes, sir. Esteemed and eminent speaker of this evening, CAS Venkatramani sir from Bangalore, Secretary of SIRC, CA Panaraj from Bellary, senior members, friends, very good evening to all of you. It gives me immense satisfaction to once again join with you this great evening. On behalf of SIRC of ICAI, I welcome the great speaker of this evening and I express my sincere thanks to him, the learned resource person CA Venkatramani sir, for accepting our request and share his wisdom amongst our elite professional gathering. I also welcome each one of the members who are all participating in this evening program, and I deem it my present duty to offer my hearty thanks to the members who support by their participation to our programs has been instilling confidence. CAS Venkatramani sir has spoken in many of the forums of SIRC and its branches on various subjects, which shows his love and affection to SIRC and to the profession. His acumen and extensive knowledge on GST would provide the participants an in-depth insight on today's topic, GST, the input tax credit, and make this evening an enlightening one. I am sure the exposure that the participants will get on the subject of presentation by the speaker of the eminence and his expertise will broadly update our understanding on the latest provisions and the sections that govern the input tax credit. The GST tax regime had formulated different provisions, the compliance procedure for the taxpayers. And as a chartered accountants, we need to constantly update our knowledge as this area is dynamic with the circulars and notification issued from time to time. Therefore, meetings of this nature with the focused discussion on specific areas in GST, like input tax credit, will help us to great extent. With this, I request Secretary of SIRC to introduce the speaker of this evening to the viewers.
Thank you, sir. Thank you for your welcome address. And once again, welcome this great speaker, Venkatramani sir. I take the pleasure of introducing him formally. Sri S. Venkatramani is a chartered accountant, a graduate in science. He pursued the chartered accountancy course and qualified in the year 1988. He was an independent practice for a year prior to joining Messrs. Singhi, Dev and Unni. He is practicing in the field of indirect taxes since then and is mainly involved in indirect tax planning and representation at various levels. He is a regular speaker at various fora and has presented a number of papers on indirect taxes at the state and national level. He has co-authored the 3 books, one a handbook on value-added tax, the second on audit under the KVAT laws, and the third discussion paper on the key transitional issues in proposed GST regime. He has served as an executive member of the Karnataka State CA Association during the year 2002-3, a member of the GST committee of the ICAI, a co-opted member of the Fiscal Laws Committee of the ICAI, co-opted member of the State Taxes Committee of FKCCI, a member of the GST Committee of the Subcommittee of SIRC of ICAI, a member of the Indirect Tax Committee of ASSOCHAM, a member of the GST Committee of the All India Federation of Tax Practitioners, a member of the Journal Committee of the All India Federation of Tax Practitioners, a co-opted member of the Indirect Tax Committee of the ICAI in New Delhi, a special invitee of the Indirect Taxes on Committee of the ICAI in New Delhi, mentor for the indirect and the indirect tax and the state taxes expert committee for the year 1819, Bangalore Chamber of Commerce and Industries. Presently, he is a member of the Fiscal Policy Institute of Government of Fiscal Policy Institute of Government of Karnataka involved in structuring, designing the course curriculum for the officers of the Commercial Tax Department, a regular faculty of the Bangalore branch of SIRC of ICAI, a member of the Statutory Compliance Committee of the Karnataka State Cricket Association, a member of the Committee to Study and Report changes to the Karnataka Tax on Profession, Trades, Callings and Employments Act 1976 and rules made thereunder by Government of Karnataka, a member of the State Advisory Committee for GST, Government of Karnataka. I present before you the dynamic and versatile speaker and who is popular. In fact, he doesn't require any introduction. As a formality, I have introduced him. And to put one sentence extra, any indirect tax initiation of the Government of Karnataka, no committees from the beginning of VAT regime till date, every time he is inevitable for the Government of Karnataka. We are very proud of you, sir. We are very happy to receive you here, and the floor is yours. We are happy to take your views and keen to listen to you. Thank you, sir.
Thank you.
This session is going to be of 3 hours. I would request the speaker to take 5-10 minutes break around 5:30. 6:30, sorry, 6:30, sir. 5 to 8 is
Yeah.
the session. Yes, sir.
Correct.
Thank you. Over to you, sir.
Thank you. Thank you so much, Secretary Sir, for that introduction. Chairman Sir, thank you very much for that welcome. Despite your challenging position of being chairman and moving around throughout South, I see you in a car for this session, having welcomed me. Thank you so much for taking this time out to welcome me. Thank you so much. Chairman Sir, you do have my permission at whatever point in time you think that you are going to get disconnected from this session or you need to move further, because I understand you're going to Cochin. Please move on. I know what the position of chairman as chairman of SIRC demands. Thank you, Panaraj sir, for that introduction. I don't know whether I deserve all of it, but people have chosen to put me in those committees. I always do my best, whatever little I can, insofar as academics is concerned. And just before joining this video conference, I was talking to Panraj sir and saying, I'm happy with my academics. I don't want anything else. Thanks, everybody. Thank you, SIRC of ICAI. Before I forget thanking for having given me this opportunity, SIRC of ICAI has been the platform. I'm indebted to the CA Institute. Let me be honest. I think Panaraj sir will acknowledge the number of times I have spoken in Karnataka and the number of times I have spoken for SIRC or ICAI. But for this ICAI's platform, be it the branch, be it the zone, be it the region, or be it the center, I don't think any other speaker would have got this many opportunities, and that too in an indirect tax. So thank you so much. Whatever little I am today, I'm proud to say that it is ICAI which has given me these opportunities, the branches, the local branches, the regional branches, including the SIRC and ICAI, which has given me this pedestal. Thank you, my alma mater. I'm ever indebted to you for this opportunity. Now let's get to the topic of today's session. Before I share the screen of what I am going to speak today, I was speaking to Chairman Jalapati sir when he called me over phone and told me input tax credit. How much time would you need? I told him, sir, you give me 1 day. But if something is left over, we can always take it on the second day. He did not know how to react. He was thinking that I was joking. Importantly, he did not realize that I was making a very serious statement. I had to spend 1 minute to him and convince him, saying that, sir, I am really serious. I am talking of a full 6 to 7 hour session on 1 day, and still it will not be enough. We can move it to a second day. So he did not know how to react to it. Then he told me, sir, I have only 3 hours. You want 1 speaker or 2 speakers? I told him, if you want me to speak, I will need that full 3 hours. But if you want me to share the ICAI time with somebody else, you can do so. You give me 1 hour also, I will be happy. So from that point to now, I have been trying to figure out what is this input tax credit issues that I have to be speaking. I am aware that all chartered accountants who are practicing indirect tax would have gone through this input tax credit, say, pain points, the headaches that are involved in input tax credit, the entire refund mechanism, the matching concept, etc. Having said that, I must also remind, now that the Secretary of SIRC is here, I must remind the Secretary of SIRC that although there are hundreds of chartered accountants who have called me and told me, what sir, audit is taken away. I want to tell the chartered accountants who are in this program today and those who are listening to me, don't worry. If audit is gone, nothing will happen to practice. Don't bother about practice. Your practice will only get better. It will get better. Now, I have many reasons to say so. What you were doing by way of 9 and 9C, you were cleaning up the mess of the client by preparing his annual return in Form 9 and the reconciliation statement in Form number 9C. Now that this 9 and 9C is gone, I'm sorry, 9C is gone and 9 will continue. There's nothing in Form number 9, which is the annual return. It is the summation of all the returns that will be there with a few modifications in Table 5. Nothing else is there in Form 5. All the issues that you are cleaning up in your 9C, I'm using this word very responsibly. When I say cleaning up, there are several taxation issues which you might have left out. You are cautioning the client that this transaction may not be credit worthy. You are cautioning the client that credit will not be available. For example, rebating mechanism. For example, reversal of input tax credit, blocked credit, or unavailable credit, ineligible credit. You were cautioning him when you came to 9C. Now that opportunity is lost. They are now going to have a self-certification of 9C, which is to be done by the client. So don't bother. Don't worry about the fees. Don't worry about the work that has gone away from you. I'm pretty confident that you will have much more work next year than what you had this year. Now, from what kind of confidence I'm making this statement? Let me give you some insights into what is happening. The government now believes that because the reconciliation statement in 9C is taken away from the chartered accountants, they want to increase the number of audits under Section 65. So when the number of audits goes up, the number of notices will go up, the quantum of work that you will be doing is higher. Therefore, when you get into litigation practice, I am again making this statement with a tremendous sense of responsibility. Chartered accountants who are listening to me, I want them to pay attention to what I'm saying. I want you to be commensurately charging fee for this litigation and representation work. If you don't do that, they will brand you or they will treat you as a CA who is not a litigation expert. So the moment your fee levels go up, they believe that you will be spending time with them. They believe that you will do a good job in representation. They believe that you will be doing justice for the work that they give you. So I think accordingly your fee levels should go up. So when you go in for a 65 audit, nothing changes. You will be looking at the same reconciliation statement once again and representing the client. I believe that the fee may be delayed, but the fee will not be denied. Having said that, those of you who are chartered accountants who are looking at Section 66, Section 66 is a special audit equivalent or similar to 142(2)(a) of the Income Tax Act 1961. So when you are looking at Section 66, the government is likely to increase the number of audits that are to be given to chartered accountants as special audit under Section 66. Now, the special audit, I think Panaraj sir would agree with me that I am sure the state commissioners are looking at the GST Council to create some kind of a panel. I am 100% sure that the ICAI will be consulted when they create this panel, which is likely to happen in the next 3 to 4 months. Please enroll in that panel. You are likely to get some very good audits on special assignment. If chartered accountants do justice, I don't know the fee quantum that they are going to be looking at. There will be some panel or committee which will look at fee fixation, like how bank audit fees, etc. is fixed. Surely there will be some methodology that they will arrive. Otherwise, it is a negotiated fee under Section 66 subsection 3, which the commissioner will be paying. I am sure it will be decent enough or good fee that the chartered accountants will get. So don't worry about losing audits. Don't worry about audit being taken away. Yes, we feel bad. When we were doing a good job, this audit provision has been taken away from us. So it just doesn't matter. So let us not worry about it. I think we need to move forward. I don't think we have lost much. In fact, we have only gained. We will not lose. With that confidence building measure, let me move on to today's topic of input tax credit. The input tax credit that most speakers speak will be related to provisions of 16, 17, 18, 19, 20. Then they will go to probably Section 34, move to Rule 46, then move on to specific rules relating to 44, then they will move on to the forms, etc. Now, I don't want to get into those forms. I will share that PowerPoint presentation, which you go home, you read, you will know what is the provision. I don't want to spend time. I want to really move up the issues that are involved in input tax credit mechanism. Now, there are substantive number of issues, which once again, I'm saying with a fair sense of responsibility that as chartered accountants, there is a good possibility that we might have overlooked when we did the audit or when we compiled the annual return in 9 or the reconciliation statement in 9C. I want to give you a heads up on the issues that the department is likely to look at and how this is going to impact your litigation process, the representation process, the ability to think and go ahead. Now, when you look at the PPT that is going to appear in front of you, Selva sir or Pandrak sir, if you can confirm to me whether you are able to see the screen.
Sir, yes, sir.
You are able to see the screen, right? Good.
Yes.
Now, if you look at the screen right in front of you, I am looking at GST impacting aspects. Now, you might be thinking, why is this man speaking of GST impacting aspects when his topic is input tax credit? I am looking at it in a two-way direction. One, if there is going to be a tax on a particular transaction, that will become an input tax credit in somebody else's hands. So you please adjust yourself, or you please think accordingly, whether you are representing a supplier or whether you are representing a recipient. If you are going to represent a supplier in respect of the transactions that I'm going to tell you, there will be a tax. If you are going to represent the recipient, you please look at input tax credit. Whether you claimed, you're availed, you're eligible, you're ineligible, it is blocked, you will have to reverse. You're claimed, you're entitled, you will have to look at these aspects before even you lay your hands on input tax credit. So please be extremely careful while looking at input tax credit. I am talking output tax because it will become input tax in Panarat's hands. Panarat sir, I'll be using your name as an example. Please don't feel bad about it. Right? Now, what is the first issue that came up? Let me give you one example in Karnataka, which went to the enforcement authority. An enforcement officer visited a jeweler. Now, there is no bias. Again, the examples that I will be giving you will be sector specific. I have no bias that it is jewelry, it is furniture, it is coffee, it is tea, therefore it is Bangalore, it is Chennai, nothing like that. I am just picking up examples which out of sheer experience I know are issues that will come up. Let me give you an example. An officer who visited a jeweler was looking at input tax credit in respect of this jewelry entity. He suddenly came across an input tax credit claim of 1 lakh and up. I'm not talking insurance amount. I am talking insurance claim of 1 lakh plus. This officer fell down. He thought, what is this input tax credit relating to insurance of 1 lakh that this jeweler is claiming? That means, what is the quantum of stock and the debtors that he should have insured, cash that he should have insured, the showroom furniture fixtures that he should have insured. So he got a doubt. He said, okay, bring your policy. So he brought the policy. Physically, this payment was made. A sum amounting to 5 crores was insured. It was stock, it was cash, it was showroom furnitures and fixtures, hallmarking machinery, bullion, specie, all of it together insured for 5 crores. 5 crores. I'm not talking 1 or 2 rupees. Then this particular officer, he got a further doubt. He said, 5 crores is the running stock. Therefore, this man must have substantive turnover. Then he looked at the turnover. Turnovers did not exceed 5 crores. He said there is no stock turnover exceeding 1 time at least. That means equal to stock, there must be turnover. Then he asked him, what is the average running closing stock that you are carrying on a day-to-day basis? So he picked up the profit and loss account. In profit and loss account, he found the closing stock of 1 crore, 1.5 crore, 2 crore, etc. So when he got it out, he asked him, why have you insured yourself for 5 crores? While your average closing stock is only 1 to 1.25 crores. Why are you doing? He said, no, you will have to look at peak stock. What is peak stock? Peak stock is a stock that you will have to declare, that you would possess on one particular day or a few days in the whole year. So he said, okay, let us look at peak stock. Peak stock did not exceed 2.3 crores in the books at all. So he said, your peak stock is also 2.3 crores. So he went back one more year. When he went back one more year, the story did not change. Now, in sum and substance, what was happening here is the book
So sorry
stock.
to interrupt. So
Yeah.
1 minute. So can you just put it in presentation mode, sir? Sorry, a lot for us. Yeah, fine. Yeah,
Now, okay?
yeah, yes, sir. You can keep it this way, sir. Many were asking this. Thank you. Thank you. Thank you.
Yes. Yeah, thank you so much. So I'm also visible, right, Selva?
Visible, sir. Yeah, visible. Visible. Very much audible. Yeah.
Thank you so much. So, so what was happening? He went back a couple of years, and in all of these years, this became the situation. Now, the entire story revolved around book stock not matching with physical stock. Now, why am I saying this? This will impact your input tax credit. What happened here was the assessing officer took up this issue. He said, I will restrict your input tax credit on an estimated basis. This will go in appeal. Whether we will win or not is another matter. Now, those of us who are doing audit will be looking at the 4 conditions that are involved here. Whether he possesses an invoice, answer is yes. Whether credit has been uploaded in one, yes, the answer is yes. Whether the supplier has filed his return and effected payment of taxes, the answer is yes. Therefore, how can credit be denied? Now, credit can be denied in respect of transactions which are fictitious or which are not in accordance with the books and records maintained. Here, all the entries will be available in the books and records. So he restricted the input tax credit to 40%. 40% of the insurance claims, 65,000 rupees he disallowed. He said, you go on fighting in an appeal. Why am I giving you this example? I'm giving you this example because one of the input tax credit restrictions could also be on account of inward supplies. Please be careful, related to stock that is held by the assessee from time to time. Now, this can lead to difficulties in income tax. You know it better than what I am doing. Please look at it the way you want to look at it. Having given you this example, now look at the basis of information which are not in alignment. Accounts based on accrual and matching concept. Now, if I were the commissioner and if Panaraj were to be the assessee, let me give you one example of accounts based on accrual and matching concept. All of us know what accrual is. All of us know what matching is. I won't get into that. Now, let me look at one particular business. Let's say contractors. Contractors who are executing contracts for government departments or any other piecemeal contractors for other large companies. What do? They maintain their books of accounts on cash basis. What is maintaining books of accounts on cash basis? They record the income when they receive the check. They don't account the running account bills. They go through whatever is that basis under income tax law where they declare 8% or 10% of the total gross receipt that is declared as income. They pay their tax, they move on in life. Now, when you look at these contractors, there is no such model under goods and service tax law. You have to follow the accrual system of accounting. When you follow the accrual system of accounting, the day you raise an invoice, which is your running account bill, you are required to offer it to tax. So your information is not in alignment with the GST law. That is what I'm trying to tell you. It can impact your input tax credit. What the assessing officer will tell you that I will not allow you input tax credit, one, proportionately to which you have not declared. Alternatively, I will make you declare the accrual invoices or your RA bills where money is yet to be received but not declared and make you pay tax on accrual basis. Because raising of invoice, receipt of money or completion of service will amount to a supply under GST law. Once the supply transaction is complete, output tax becomes payable. So when output tax is payable, input tax credit will become automatically available, or he has an option to estimate your turnovers on a reasonable basis or deny input tax credit in accordance with RA bills that have not been raised. So look at this transaction very carefully when you are going to fill in your 9C or render advice to your clients. GST incidence is also based on time of supply concept. I will give you only one example here where it has become a major issue in respect of input tax credit on annual maintenance contract. In fact, these annual maintenance contracts are way bigger than your works contract services of contractors and subcontractors. Let me tell you why. Some of these large companies have annual maintenance contracts running into hundreds of crores. Now, in respect of these annual maintenance contracts, visualize the situation. Suppose my secretary Pandraj sir, he is a recipient, he enters into an annual maintenance contract with me for the purpose of maintenance of his machines, where he runs a factory for his machines. Look at the situation. I am going to give him an invoice today, which is, for example, 18th of March. I will give him an invoice. He will make the payment. He will claim the input tax credit on 18th of March. Now the question is whether this input tax credit can be claimed by Panaraj sir. Whether it can be claimed by Panaraj sir in the month of March. In my view, considered view, input tax, I will also give you the alternative argument 1 minute later. In my considered view, input tax credit will not be available in Panaraj's hands for two reasons. One, he does not fulfill the conditions under section 16. What are the conditions required? Does he have an invoice? The answer is yes. Has the supplier of services uploaded this and paid the taxes and filed the return? The answer is yes. But he doesn't satisfy the fourth condition of receipt of services, because the receipt of services will be spread over a period of 12 months. When you look at the accrual and matching concept in respect of companies, they would have said annual maintenance contracts, payments made, they will be showing it as an asset in the books of account and the balance sheet, where they will say that the services have not been received in respect of this transaction. So they will say just as previous, advances recoverable in cash or kind of value to be received. So they will show the unexpired portion of the annual maintenance contract as asset in the balance sheet. Now, having said that, if the supplier's entries and the recipient entries don't mirror, when I say mirror, how he is showing is how Panaraj sir should reflect. Therefore, in my considered view, credit will not be available. But there are some experts who argue, sir, how can you argue like this, sir? In respect of annual maintenance contract, you can always take a position that the supply is deemed to be concluded on the date on which invoice is raised, because the time of supply will be the time at which an invoice is raised and money is paid. Well, you can take that argument insofar as time of supply is concerned. But in respect of credits that will be available to you, I'm afraid that you will have a very difficult case to fight in respect of annual maintenance contract. How do you tide over this difficult position? You can tide over this difficult position by telling the supplier, in our Panaraj sir's case, the supplier is me. You can tell him, we will enter into a contract today. I will also make the payment today, but you give me monthly invoices. The moment monthly invoices come in, credit will accrue on a monthly basis. Credit will become available. So please be careful. Accrual and matching are going to pose very, very difficult situations insofar as GST is concerned. There are many examples, but I've taken the simplest of examples. Identify inherent differences based on industry and sectors. Now, the difficulty based on industry and sectors, I will give you one example. The difficulty in identifying whether a transaction is goods or a transaction is service. Now, take the case of a product called Care Pack. What is this Care Pack? This Care Pack is a contract entered into between the supplier and the recipient. Those of you who know Hewlett Packard will know that Care Pack is a product. This Care Pack is nothing but an annual maintenance package. Now the question is whether this is a product or whether this is a service. Why? Because in Hewlett Packard sells this package through dealers. Hewlett Packard cannot service lakhs of computers that are situated across India. So what he does, he will appoint Panaraj sir as a dealer. He will tell you, if you are having, for example, HP Pro Lab 9.4 series computers, then your Care Pack cost will be 3,700 rupees per annum. So this will include part, this will include one service, this will include something else. Now what Panaraj sir does, Panaraj sir will again go and give this to another sub-dealer or a dealer who is selling computers. That is the man who is going to command services. So in respect of claims from Hewlett, once the annual maintenance contract is done by the sub-dealer will raise an invoice on Panaraj sir will raise an invoice on Hewlett Packard. Now look at this difficulty here. I want to identify whether this is goods or service. The department says care pack supplied by HP to Panarath sir is a product liable to tax at 18% because there is no classification. The care pack supplied by Panarath sir to the sub-dealer is a product liable to tax on miscellaneous entry. The third sub-dealer who actually physically goes and services the product in your office or in your house, that is a works contract service. Be careful, you can get into such situations. The last one you will be paying tax at a low 18%. The first two if it is product, and let us say tomorrow the rate of tax changes from 18 to 21% because they may unify the rates of tax 28 and 18. They may bring it to 21 or 24. You can run into difficulty of inverted duty structure. Take your stand now. Don't wait for the issue to flow in. Next, look at the expansion of GST into newer areas which will also hit your input tax credit. Taxable and non-taxable turnover, both are to be reported. No difficulty in understanding taxable turnover because taxable turnover is a turnover on which tax is required to be paid. What is non-taxable turnover? Non-taxable supply or non-taxable turnover is defined to mean the turnover on which tax is not leviable. Be careful. Tax is not leviable. It is not a case where tax is not payable. It is where tax is not leviable. Those of you who want the section reference to subsection 78, where tax is not leviable. For example, alcoholic liquor for human consumption, petroleum products, electrical energy. These are transactions which are non-taxable transactions. Please be careful. They are non-taxable supplies. Now, if you look at 247, 2 subsection 47, exempt supply includes nil rate or wholly exempt under section 11 or non-taxable supply or a non-taxable supply. So exempt supplies include non-taxable supply. Non-taxable supply means supply on which tax is not leviable. You are required to report both. Let me give you one example here. Take a case of a hotel, a 5-star hotel, let us say Chola, which is there in Chennai, or I don't know, Oberoi, which is there in Hyderabad, or a West End or Vinsaman in Bangalore, and maybe a Taj in Kerala. All of these hotels have got bar and restaurants. When they have bar and restaurants, there is obviously sale of liquor. Liquor is outside the goods and service tax law. It's outside the purview. Now consider this situation of Panarath sir, I, and our chairman Jalapati sir. If three of us go to this bar and restaurant, Panarath sir will have only dinner. Jalapati sir will only have tomato juice or fresh fruit juice. Suppose I have liquor. All the three of us get into this restaurant, whereas this restaurant will raise one common invoice, one in respect of the juice that Panarath sir has, Jalapati sir has had, some whatever dinner that Panarath sir is having, and the liquor that I am drinking. Now, in respect of all of these transactions, there are common credits. What is common credit? Common credit is the security who is standing at the entry gate. He doesn't know whether Panarath sir is going to drink or Venkat is going to drink or Jalapati sir is going. He will let all the three of us inside. So there is a common cost of security services. Now, the moment we enter inside and come towards the door, there will be one more security who will check your bag, baggage, all this he will do. That is a second security check. When you go to the third place, you enter the bar and restaurant area. When you enter the bar and restaurant area, all three of us are going to sit at the same table. The furnitures and fixtures on which he has claimed input tax credit, where I am drinking, Panarath sir is not drinking, Jalapati sir is only having juice. Now you look at these three transactions. We are sharing a common table. In fact, I could get liquor in the same glass in which next time some other customer comes, Jalapati sir may get juice, right? So it is perfectly possible that crockery and cutlery, the spoons, the forks, the knives, the clothes, the linen that is used on table, the plates that he serves on will all be common. Now the entire common input tax credit is required to be reversed under 42-43 in respect of this transaction of non-taxable turnover. So if there is a hotel industry that is running, and if I am not seeing reversal of input tax credit under 42 or 43, mentally get clear that you are a sure shot for the purpose of audit under section 65. So you have to be careful of reversing input tax credit. If you don't reverse input tax credit, you will have difficulty. The difficulty is not in reversing. The difficulty is in the manner of reversing input tax credit. How do you reverse input tax credit? Department will tell you, reverse it based on turnover. Now you look at the turnover. I am a drunkard. I am drinking. My bill will be 1,000 rupees. Pannarak sir is having only one snack. His bill will be 250 rupees. Jalapati sir is only having a juice, which will be only 150 rupees. If you are going to reverse the input tax credit based on turnover, liquor turnover will be the maximum. That means 70 to 80% of the input tax credit can get reversed. It can get reversed. Now, whether you have to reverse based on turnover, you have to reverse based on footfalls. You have to reverse based on number of people who are drinkers versus non-drinkers, which is near impossible to get that data. Now, this is the difficulty that you will have when you are going to reverse input tax credit under 42-43. No supply transactions also affects credit reporting. What is a no supply transaction? A no supply transaction is Schedule 3 transaction. Now, Schedule 3 has only services, but look, when they look at it as supply in terms of goods, it has only service. Please go and look at Schedule 3. It has no goods at all. It is only services. Now, when you look at Schedule 3 transactions, no supply transactions are transactions which are there in Schedule 3. In Schedule 3, but you have one or two transactions which are related to land and which are in respect of transactions which are outside the jurisdiction of India. For example, you will have transactions like IC sales, you have outbound sales, which is one country to the other recorded in the books of accounts in India. Even in respect of those transactions, input tax credit is required to be reversed. Please look at the impact that it is going to create in respect of input tax credit. Take a hotelier, take a IC sale transaction, which are governed by Schedule 3. It is good for you to take exemption, but don't forget to reverse input tax credit. If you don't reverse, you will run into extreme amount of difficulty in respect of these transactions. Look at a transaction of no supply transaction in respect of transactions like hospitals, educational institutions. While these output may be exempt, certain transactions where input tax credit may be allowed because output tax will become payable. For example, canteen services, sale of old goods. In respect of all of these transactions, output may become payable, but corresponding input tax credit you will have to be careful because input tax credit will certainly get impacted in respect of these transactions. Please apply your mind. Next, we talk of accounts permit credit in expense account and amount retained in current liability in balance sheet. Amount retained in current liability in balance sheet, I just discussed, annual maintenance contract. When you receive the money, the supplier will show it as current liability because in the subsequent year, he will show that as income. Current year, it's a liability for him. As and when the ANC period is over, he will show it as income, which means output life payable at the commencement of the contract, whereas income will be reflected in the subsequent year. It is a perfect reconciliation item. Accounts permit credit in expense account. Now, what is credit in expense account? I want every chartered accountant who is present here to visualize a normal trading account. What do you have in net trading account? You have opening stock, you have inward supply, or what is commonly called purchases. Then you have wages, direct wages. Then you have gross profit, and you have the total. On the other side, income side, you have output supply or sales. You will have, I don't know whether any other direct income related to sales. You will have closing stock and you will have the total. Now, what is credit in expense account? Credit, consider your inward supply or purchases. It will be inward supply less return. Example 1, inward supply less return. Net purchases or net inward supply will be shown in the outer column. It can be inward supply or purchases less incentives. It can go to the outer column. Inward supply less discount, which can go to the outer column. I realize after years of practice that some adjustment in GP also takes place by reflecting the credit in expense account in the trading account, right? I'm sure chartered accountants who are involved in your tax audits or income tax returns would know what the impact of gross profit would be if you are going to reflect credit in expense account. Forget it. We will keep income tax aside. Deal with it when it comes in income tax. Now, insofar as indirect tax is concerned, be very careful of credit in expense account. Let me give you one example of credit in expense account. Inward supply, yes, discount. I want you to examine this discount. Please examine this discount, whether this is really discount in terms of section 15 subsection 3 of the CGST Act. If it is not discount in terms of section 15 subsection 3, you will not be able to show it as credit in the expense account. It is something else, but it is not discount. To answer the description of a discount under the GST law, it should answer two conditions. One, it must be reflected on the face of the invoice, and second, on the face of the invoice, be very careful. And second, it must be in respect of the terms of agreements between the supplier and the recipient, which means there must be an agreement, there must be an understanding, there must be a purchase order, there must be a scheme that is running which both the buyer and the seller knows. All other cases, it cannot be credit in the expense account, it is something else. Let me give you an example. All of these people who are taken to Singapore, Hong Kong, I don't know wherever, USA, on achieving the targets, etc., where credit notes are issued, these are not discounts. These are incentives. Incentives are liable to tax at the rate of 18%. It cannot be reflected as credit in expense account, but it should be shown as other income in P&L account below the line. It must be shown below the line. That means it must come to profit and loss account. Taxes payable at the rate of 18%. Credit note cannot be issued by FMCG goods suppliers of FMCG goods. When it is a price protection case, please be careful. I am looking at price protection as a completely different transaction other than discount. What is a price protection? That means I will tell Pannarak sir, please sell this iPhone 11 because iPhone 12 has come. Please sell this iPhone 11 at 15,000 rupees. 3,000 rupees I will give you a credit note. It is not discount. It is price protection. If you protect the price, tax will be payable at the rate applicable to the product. It is not discount. It is not credit in inward supply account, but it is price protection. It will be liable to tax at the rate applicable to the product. Therefore, credit in expense account is something which you will have to be extremely careful of. Be careful. Beyond this, I don't have the time to tell you how to look at it. Let me give you only one issue in respect of accrual before I close this slide. It is very important for chartered accountants to look at notes to accounts or connecting statements that they are called. Notes to accounts and connecting statements. Now, what is notes to accounts and connecting statements? We have two classes. One is notes to accounts and the second one is notes on accounts. Notes on accounts is a significant accounting policy, etc., capitalization, etc. Now, notes to accounts is the manner in which you have prepared the account. Now, consider the situation in notes to accounts where Pannarak sir is the auditor for a company which is, let's say, a private limited company. He makes an innocuous statement in notes to accounts by saying revenue is recognized on dispatch of goods. If he makes this innocuous statement on notes to accounts, look at the transaction on 31st March. Invoice may have been raised. Be careful. Invoice may have been raised. Tax may have been remitted, but goods will move only one day later. Now, these transactions you will have to be very careful when there are rate changes. Importantly, in November 2017 and February 2018, when substantive changes were made to rate of tax on goods and services. At that point in time, you will have to be careful because invoice may have been raised on 15th of November. 14th of November 2017 is when the rates changed. So invoice may have been raised at a lower rate, at a higher rate. Goods should have moved when subsequent to the date on which there was a change in rate. Reverse is also true. In order to avoid anti-profiteering, if there is a reduction in rate of tax, invoice may have been raised, goods may not have been moved. It will move much later. Please look at these transactions in respect of accrual concept and matching concept and then take your decision. Now, some of these transactions are crucial insofar as input tax credit is concerned. Are crucial. Barter was not liable to tax under goods and service tax law. Supply includes sale, transfer, barter, exchange, lease, disposal, etc., etc. All those 8 words. Now, barter was not liable to tax. we have some confusion as regards barter and exchange. Let me put that to rest at one point in time. Barter is a transaction where there is no value. That means it is my watch versus Pannarat sir's spectacles. Pannarat sir will give me his spectacle. I will give him my watch. Both of us are not assigning any value to this transaction. We are not assigning any value to this transaction. Be extremely careful. It is a transaction of barter where there is no value assigned. Now these are called supply transactions. Both these are taxable at different rates. For example, my watch could be taxable at the rate of 18%. Pannarat's spectacles could be taxable at the rate of 12%. In respect of a barter, valuation mechanism will kick in. There is no reason why the supply value should be equal to the recipient's value. No, both values can be different. Both will go to valuation under section 15 read with rule 31. Like kind, 30, like kind, like quality at or about the same time. Barter transactions are taxable. Those of you who handle large companies, let me give you an example, because Pannarat sir comes from Ballari. I would want to give him this example of Jindal, where in Jindal, I'm sure Pannarat sir will be able to relate to what I'm saying, where Jindal barters Corex gas for oxygen. Corex is a byproduct. Corex is a gas which is a byproduct in the smelting process. In Jindal, it is captured, used for generation of power. What cannot be captured, we give it to oxygen making entities for firing their furnaces for production of oxygen, and in return, Jindal of this barter transaction, by giving 1 cubic meter of Corex gas, I get 0.62 cubic meters of oxygen. Both these are barter transactions where value is not fixed, and therefore both these could be taxable at completely different rates. Now, corresponding input tax credit will also stand affected. If you don't declare these barter transactions now, you will not be in a position to avail the corresponding input tax credit subsequently. It can be denied in your hands. 1, 2. Second, in respect of exchange transaction, there is a value that is fixed. Now, what is the distinction between a barter and an exchange? A barter is a transaction where there is no value fixed, whereas exchange is a transaction where there is a value that is fixed. Go back to input tax credit that I was talking of in the earlier slide. Consider this transaction of exchange. Please bring your old washing machine. Take away new Whirlpool or Bosch washing machine. Is the advertisement that is streams across the streets of Chennai. Now, what is the value that is fixed for this exchange transaction? They can fix it in many ways. They will tell you, you give your old washing machine, new Bosch washing machine will be given at 42,000 rupees. If you bring your washing machine with the purchase invoice, the time when you purchase, then instead of 42, I will give you 5,000 rupees credit. It can be both. It can be both, or it can be in any other way. Now, in respect of all of these transactions, I want the chartered accountants to apply their minds and examine where is this old washing machine being accounted in the trading account. Where is it accounted by these entities? Are my chartered accountants telling me that it is scrap, it is therefore not accounted? Or are they saying that there is an adjusted price in the supply, therefore I don't need to account? No, sorry, both are wrong. We need to gross up the transaction. There is an inward supply of old washing machine and an outward supply of new washing machine. If you don't pro rata input tax credit, I will reverse. Alternatively, if I'm not able to do that, I will value these old washing machines by taking the price of one new washing machine where this exchange transaction has not taken place. My bad luck. If all the transactions that have taken place are old rates, then I will resort to estimation under section 31 and increase the outward supply value. Child accountants, be careful. In my practice of 30 years, I have not seen the accounting of inward supply of these transactions, at least in so far as the transactions that I have come across. Some of you may have taken care of this position, but touch your heart and look at this transaction. There is an exposure, there is a substantive exposure of either output tax or restriction of input tax credit. I don't have time to take another example. I will leave it at that. Now, this is insofar as barter and exchange is concerned. I have given you one transaction each. Now, The old world, please be extremely careful. Old world, we have to be very, very careful in respect of old world. There are two transactions, one is inward supply and the second one is outward supply. Please be extremely careful in respect of old world transactions. I don't have time. If I find the time, I will come back to it. Classification, valuation, time, place of supply is need to be reviewed afresh. Now, classification is HSN there. Now, I always give the example of this leasing, hiring, renting, leasing, hiring, and renting. After so many years of practice, I have not understood completely, clearly, and unambiguously the meaning of these three terms: leasing, hiring, and renting. Chartered accountants who are in indirect tax practice will know that there are different rates of tax for this. Be very careful of your HSN codes. You are putting the input recipient into jeopardy by not classifying it correctly. Leasing. All chartered accountants in this seminar will turn around and tell me, in a study circle meeting will turn around and tell me, sir, what are you telling me, sir? Leasing means there is a transfer of right to use goods where there is transfer of possession. Now, what happens to transactions like bounce, Zoom car, Hertz rent a car, JCB with driver, JCB without driver? Please apply your mind. Please apply your mind. When it comes to Hertz rent a car without driver, you say no, sir, this is lease because you are put in possession of the property. Therefore, rate of tax will be 28% as a lease transaction. Now, what is the distinction between leasing, renting, and hiring? You lease Hertz rent a car, but do you hire an Uber or rent an Uber? Please look at this transaction. Uber, Ola. Do you hire an Uber? Rent an Uber. Do you hire an auto rickshaw or do you rent an auto rickshaw? Panarath sir, what he will do? He is sitting in Ballari. He will call, for example, Ballari Travels, and he will tell him, send me a car for 3 days. Is it leasing? Is it renting? Or is it hiring? Be careful. When it comes to Uber, you are saying it is hiring. When it comes to taking here, you are saying it is rent-a-cab services. Now, what is renting? What is leasing? What is hiring? If I confuse you with, let's say, a JCB, a bulldozer, or an earth mover with the very same example, you will get completely confused. So let me conclude by saying, leasing is a transaction where there is a transfer of right to use goods which is given, where possession is transferred. Possession is transferred to the customer, is a transaction of leasing. Renting is a transaction where the destination is known. Destination is known. And for hiring is a transaction where destination is known before commencement of embarkation. Renting is a transaction where destination is unknown. Panarath from Ballari's case, send me a car for 3 days, is a transaction of renting. So these are rent-a-cab services. In all these cases, the taxes are different. Please be careful. You have a 5 without input tax credit, 12 with input tax credit, 18% in case of hiring, 28% in case of leasing. Same way in the case of JCB, earth movers, etc. Please be extremely careful when you give these transactions some color. Therefore, GST gives new treatment to old transactions. If you apply the wrong rate, the recipient will not get input tax credit. Please be very careful. That is why I said GST gives new treatment to old transactions. Now, I will skip this because this is related to annual return and reconciliation statement. There is nothing new in this. All of you know what I am talking about. So I am not going to spend any time, except the third bullet point. Non-disclosure of information would amount to suppression in terms of section 73, 74, and 75. Please read the explanation to 75. It will tell you what suppression is. Therefore, my suggestion to chartered accountants is, wherever there are two views possible, please give the view that you have subscribed. Now, when I give you some other examples subsequently, I will tell you. Let me tell you, for example, in the case of samples, business promotion, entertainment, gift, etc. Please disclose the view. I will come to that next slide and you will see how it is going to impact your input tax credit. Notes and disclosures, of course, are very useful. Now, you are required to report all turnovers, including exempt and non-GST transactions in 9 and 9C. Why? Because there is the reversal. In the example that I gave you earlier, hotel, bar. Now look at another example of generation of electrical energy by way of windmills or solar farms. Most of these companies are engaged in generation or distribution of power. Generation of power, importantly, they are not involved in transmission and distribution. Generation of power, electrical energy is exempt. Common credits will be involved. Common credits. I am not talking of specific credits. You will tell you, sir, on solar panels I have not claimed, on maintenance I have not claimed. But what happens to audit fee? What happens to accounting services? What happens to security services? What happens to rent where your office is located? In all of these cases, common credits are involved. Therefore, when you report all turnover, including exempt and non-GST or no supply transactions, please remember this no supply transactions. I will come back to that no supply transactions if I have time. If you can put it in the question and leave it, I will come later. So, including exempt, non-GST, no supply transactions. You have to be very careful. Input tax credit is going to get reversed. Be careful to report electrical energy. Those of you who are chartered accountants looking at mall accounting, MALL, mall, shopping complexes, where submeters will be installed. I'm not talking of meters. I'm talking of submeters, where you take electrical energy at a specified rate, 12 rupees per unit, or at the actual number of units at the rate supplied by discoms and escoms. Please be very careful when you do that. There could be an exposure to tax. If you have not availed input tax credit, you will be paying output tax credit now. Please take a call whether you want to pay output tax and avail input tax credit, because input tax credit will anyway get restricted if you don't declare output tax. Please be careful of these categories of transactions that I am talking of. Turnover may be accounted as credit in expenditure account. Incentives, notice pay, purchases, etc., etc. I've already talked about that. Now, credits in expenditure account, we are clear. Advance in current liability account, I have also been clear when I looked at annual maintenance contracts, because they are advance in current liability account. There is one other case that you can take up. Please look at pure agency transactions. Child accountants, I'm cautioning you about your own books, where you receive money from your client, say 25,000 rupees, and you treat that as pure agency transactions under Rule 33. You will say incorporation of company, paying fee to the registrar, paying sub-registrar's fees registrar's fees in accounts, etc., etc., paying goods and service tax, obtaining TAN, etc. If you are looking at these transactions as pure agency transactions, then in rupees and paisa, you must be able to match that. If you are going to retain that little excess or absorb that little shortfall, you don't become a Rule 33 transaction. The entire 20,000 can get subjected to tax in your hands. Chartered accountants, be very, very careful in respect of Rule 33 transactions. This is going to be the next big issue that as professionals we are going to face. Now, when we look at turnovers, books are limited to money measurement transactions. Books are limited to money measurement transactions. Where there is no money that is measured, in respect of all of these transactions, books don't portray a true and correct picture. I am not talking of true and fair. I am being very careful. True and correct statement. Now, you look for stocks given as barter or exchange in promotional schemes. Look for stocks being given as barter, exchange in promotional schemes. Now, this is exactly where I am coming to. Books don't give you this money measurement. Consider the same mall example that I gave you. Panarat sir will go to a mall in Bangalore. The moment he goes to a mall in Bangalore and he enters, let us say, for example, I don't know, a Reliance store, in that he will be given a glass of juice or he will be given a biscuit. He will be made to sit down. He will say, sir, please have this juice, sir. What do you want, sir? You want to buy 2-in-1, sir? You want to buy washing machine? What do you want to buy? All that he will come and ask you. Now, what is this class of juice that he is getting? Is it business promotion? Is it business promotion? Is it gift? Is it sample? Is it sample? Or is it entertainment? What is this? If you say it is gift, input tax you have to reverse. If you say it is sample, input tax you have to reverse. If it is business promotion, input tax credit is available because it is in the course or furtherance of business. Is it entertainment? Input tax credit will be available. So how you book your entry in your books of accounts becomes extremely crucial in this respect of these promotional schemes. Now, with the example of juice I gave you, take for example, step into a Vistara flight or an Indigo flight, he will give you a Britannia biscuit. Now, whether this is business promotion, advertisement, be careful. I'm now moving to the next level. Whether it is business promotion, whether it is an advertisement, whether it is a sample, or whether this is entertainment, take your call, and that call is based on facts. That call is based on facts. Sitting here, I cannot tell you what is the entry in respect of the biscuit that you get when you sit in an aircraft in Vistara. Now, similarly, you look at transactions in respect of business promotion, advertisement. Those of you who buy Times of India, a shampoo packet or a shampoo sachet will be attached to this newspaper. It will get delivered to your house in the morning. What is this? Is it sample? Is it business promotion? Is it gift? Is it entertainment? Is it advertisement? What is this? Take your call. How you pass the entry in the books of account is going to impact your input tax credit accordingly. Gift articles given to customer for no extra consideration. It can be mixed supply. Be very careful. For example, a Ganesh idol, a tissue paper box that is given along with your car, or some mats that will be given along with the car. I don't know what all you get, but all those can be mixed supply. If you don't declare it, there is no input tax credit that you will get. Please be very careful. No input tax credit will be allowed. No transaction is entitled to be kept out of annual return. Why I'm giving you this example of securities, where in the section 45 they tell you you need to consider 1% of the value of securities. I am not on that. You look at transactions, let's say for example in Infosys. And Infosys has got 25,000 crores. I'm repeating, 25,000 crores are fixed deposits in its balance sheet, and it earns something like 5,000 crores as interest every year. Now, to safeguard this money, there is computers that are used, servers that are used, treasury transactions that happen, treasury transactions that are outsourcing accounting services that happen. You will have to reverse input tax credit because output is not liable to tax. If you don't reverse input tax credit, you are running into difficulty. So what we have done in respect of this company is we have identified the input tax credit, because if you consider this as the turnover for the purpose of reversal under 42 and 43, because this will become non-GST turnover, if you consider this as non-GST turnover, substantive input tax credit will be reversed. In order to avoid that, we identified the person, personnel, chair, table, area, air conditioner, and common expenses that are involved, and reverse corresponding input tax credit. If you don't reverse your input tax credit in respect of these transactions, you could get into difficulty. Please be extremely careful in respect of these non-GST transactions. Now, input tax reversal. I always have a problem with this input tax reversal. After 35 years of practice, I have not been able to understand this concept called credit note. I have not been able to understand. And those of you who follow GST, you would have seen this financial credit note. What is this financial credit note? These are terms which are coined. These are jargons. Law does not recognize your financial credit note and stuff like that. Law says under GST law, these are the only 4 transactions where you can issue a credit note, where the invoice value is higher than the applicable transaction value, where the rate of tax is higher in the invoice, but the rate of tax should be lower. Deficiency of quality of goods, be careful. Deficiency of quality of goods or services, and return of goods. In all other cases, there is no credit note. Your incentive, your price protection, there is no credit note concept. There is no credit note. You may issue a credit note under some other law. That means tax becomes payable. Tax becomes payable. In simple terms, tax will become payable. Tax paying the original invoice value, not to be reduced. Please be careful. Tax payable on paid on original invoice value, not to be reduced on subsequent reduction of price. You cannot reduce. Please mind this statement. I have put it in bold. Those of you who have doubts can come back to me after the session is over. Tax paid on original invoice value not to be reduced on subsequent reduction of X, because credit he would have already taken. He would have already taken. What is the big point? No point in reducing, because timelines for availment of credit will be over. Original supply is already done. Please don't reduce. 34 allows credit note only in respect of these 4 transactions, not on any other transaction. Be very careful. Discounts I have already dealt with. I don't want to get into discounts because it's a highly debated and litigated issue. Now, mirroring of treatment, mirroring of accounting treatment. I am very particular. Those of you child accountants who handle tire companies, cement companies, FMCG companies, dealerships, broking services, please be extremely careful. Very, very careful. Accounts must mirror. That means if the supplier is showing sales less discount, that means outward supply less discount. In your books of account, it must be inward supply or purchases less discount. If the supplier is showing incentives, you have to show it as other income incentives. You cannot reduce it in purchases. This has to get mirrored. If there is a reimbursement for business promotion by the supplier, it will go to P&L. Therefore, it has to come to P&L as other income. Reimbursement of business promotion expenses. Tax will become payable. Credit will become available. Credit will become available. You cannot reflect this as inward supply less discounts. You cannot reflect it and then claim input tax credit on business promotion expenses. Not possible. You will have to match. You have to match the expense versus income and then avail input tax credit. So be very careful. I talked about price reduction. I talked about price protection. I talked about business promotion. I talked about reimbursement. I talked about freebies. I talked about inter-country jaunts given to these traders. There is a quantity discount that you will get, value discount, rate discount, prompt payment discount. Please be careful to categorize discount under section 15, subsection 3. They must fulfill all the conditions for it to be eligible as discount. Otherwise, you are not going to get credit at all. Now, hidden transactions hidden in exchange schemes. I already talked about this, so I will not spend time. You have to figure out whether this is a barter or whether this is an exchange. In a barter, old for you. Watch for Canara Sir's spectacles. That is a transaction of barter. Payment gas for oxygen in Jindal's case. Now, in exchange schemes, turnover is hidden. There are 2 options. I can restrict input tax credit or make you pay tax on output. Now be careful, child accountants, of how these transactions are reflected in the trading account of the entity. In closing stock, are you showing this old television sets? And if you are showing this old washing machine, old television set, old mixing, old iron box, old frying pan in case of Prestige, if yes, what value? If you are not showing it, then you have run into difficulty. If I am the commissioner, I have both options. One is to estimate output, correspondingly estimate input and reduce input tax credit. Choice is yours. GST will turnover double in all of these cases. Be extremely careful. Additional turnover accounted as expense. Cashback. Please understand this concept of cashback. These are in respect of B2C customers. B2C customers. I'm talking of this as a clear case of output liability. In cashback given. Now consider this case where our chairman Jalapati sir goes to Chennai Mall, goes to Central in Chennai, and there he effects purchases for 20,000 rupees. He gets a cashback of 2,000 rupees. Now when he exits the cash counter at Central Mall, he has to give his credit card and swipe it for 20,000. There is no discount, but 2,000 rupees will get accrued to his credit account in Central. It will come and sit in an account number. Next time Jalapati sir goes again to Central, buys for 5,000 rupees. He can use this 2,000 rupees. It is a reduction in price. That is subsequent purchase, but a credit in respect of the past transaction. Now this doubles the turnover. Your past transactions will become 22,000. It will not become 18,000. Please be careful. Cashback turnover will enhance. Cashback turnover will not reduce. These are customer loyalties. Therefore, it is treated as customer loyalty. It is not treated as in return. So the transaction which has to be 22,000 is accounted for 20. Therefore, you are a clear case of estimation. You are a clear case of estimation. Cashback, I will add to the product and levy tax at the rate applicable to the product. Alternatively, if I don't have the patience, I will levy tax at the rate of 18% and I will be done with it. Next two examples are simple examples. Please look at it. Double benefit is very simple. All of you know that in case of depreciable assets, if the tax component is added back and your claim depreciation, you cannot claim input tax credit on such transactions. Be very careful in respect of such transactions. One point I would want to bring it to your notice. If anybody is making your client pay tax and keeping it in the cash ledger, don't think that you can adjust that against future payment of taxes. No, you have to only take refund. I can understand parking money in the cash portal. In the cash portal for the purpose of payment of tax at the time of filing the return. I can understand it. Where your return is already in process, you don't have credit balance, therefore you effect payment into the cash portal, it will lie in the cash ledger account, which you can adjust. But you simply cannot pay on 5 lakhs and say I'm going to adjust it in the subsequent month. Not possible. You have to only go for refund. You have to go for refund. I will not allow you to adjust that tax. Now be very careful in respect of the subsequent transaction. Liability belongs to the month when supply takes place. Liability, it belongs to the month when supply takes place. What am I telling you? Now take for example, Pannarat sir does not file his GST return for 2 months. He does not file his return for 2 months because nowadays 3rd month they are cancelling your registration. He does not file his return for 2 months. Then subsequently, why does he not file his return? He does not file his return because in the month in which there is a liability, he doesn't have money to pay that tax. So what he does, subsequent month he will have purchases. He will declare this turnover of 3B in the subsequent month. Adjust the input tax credit, net tax he will pay. Net tax or differential tax he will pay. I am saying it's not possible. Liability belongs to the month in which supply is affected. Credit belongs to the month where it is claimed. That means in the Pannarat sir's case, he has to pay the tax in the previous month, whereas credit will become available only in the subsequent month. Both cannot be netted off simply by filing nil return in 1 month, including the turnover in the subsequent month. Be careful. I will get hold of you for fraud under section 74. Not even suppression, fraud under section 74. You have to be extremely careful when you look at these transactions from a GST point of view. Liability to be settled with credit. Liability to be settled with credit taken or cash. Any new liability. For instance, if you come across a case where a assessee has not paid output tax on sale of assets, you cannot set off against input tax credit that is available. You will have to pay cash into the cash ledger and then effect your output payment of tax. Be very careful. Credit not yet taken cannot be utilized. Liability discovered is to be paid in cash. We have discussed all others in the month in which it has to be done, etc. Now let me come to your input tax credit issues. What issues in respect of input tax credit? Whether credit is a right or credit is a benefit. Whether it is vested or whether it is not vested. Before we get into the discussion relating to input tax credit, you will have to know how many kinds and classes of credits are there. If you look at section 16 subsection 1, it will tell you, please those of you who have the act in front of you, please pick up that. Section 16 will tell you, you are entitled to input tax credit. Please be very careful. It will tell you input tax credit, you are entitled. Please look at section 16. 16 will tell you, talk about entitlement. Whereas section 17 will talk about non-availability of credit. Section 17 will tell you input tax credit is not available. Input tax credit is not available in the following situations or circumstances. Third, Section 17 will also tell you input tax credit is partly permitted. Partly permitted. Third, it will tell you input tax credit is blocked. Then it will tell you eligibility of input tax credit in special circumstance. It talks availability. Section 18 talks of availability. Therefore, you have input tax credit entitlement, eligible, ineligible, reversal, block, avail, entitlement, claim, partial credit, reversal. Now, all of this, the sections use this in different circumstances. You will have to realize that input tax credit claim is different from input tax credit availed. Input tax credit claim is different from input tax credit availed. Therefore, what is availment vis-a-vis claim? Availment. You can avail input tax credit. You can avail. That means you can show it in your 3B, but you can claim only when you set it off against an output tax liability. You can claim. Now, input tax credit availability is different from input tax credit not available. Input tax credit may be available, but you may not be in a position to claim. Our annual maintenance credit cases. Input tax credit is available, but you cannot claim because services are not rendered. Input tax credit reverse. That means input tax credit should be brought into the books of accounts and returns and then reversed. Input tax credit not available. It cannot even come into the return. For example, in respect of work contract services of immovable properties, input tax credit cannot come into the books. It's another matter that you are claiming, fighting through safari, going to the Supreme Court. Another matter. So you have to be careful about the nomenclatures of each of these words. Every single word is crucial in respect of input tax credits, its claims, its rights, etc. So be extremely careful in respect of input tax credit claim or input tax credit eligibility. Therefore, vested right, a claim, an entitlement, an availment will vest as a right only when you satisfy the conditions of section 16 subsection 2. Practicalities aside, you have to answer the provisions of section 155. Credit is provisional until you satisfy the conditions stipulated in 155. Please go and read that. So credit is provisional. Every credit is provisional. Take your credit. Tomorrow I will come and check. So credit vests. It vests in the recipient. It vests in the recipient only when you answer the conditions of 16 subsection 2. Those of you who are chartered accountants, who are doing due diligence, who are also doing what can I say, compliance procedures in respect of clients, year ends, month ends, be extremely careful because credit will get reflected into a client cannot claim that. Let's say from Gujarat, Ahmedabad, a consignment leaves on 30th of February, 27th of February, it reaches Chennai on 2nd of March. Credit will become available in the recipient's hands only in the month of March, but it will reflect in 2A in the month of February. Don't make the mistake of claiming because it has to first vest for you to claim. You may avail, but you cannot claim. You can avail, but you cannot claim. Right? Next, eligible credit is not available until taken. You have to take the credit. That is what the law says. Credit can be taken. How can you take the credit? Credit can be taken only through 3B. There is no other process in which you can claim the credit. You cannot do it through 9 or you cannot do it through 9C. The only way you can take the credit is through 3B because 3B is a return under Rule 61 sub Rule 5 and that's the only way in which you can claim. Those of you who practice compliance, please read 155. You will have to fall in line with the compliance processes. Otherwise, credit will not become available. Now, what is credit eligibility? Credit appearing in 2A is not final. 2A is like a dustbin. 2A is like a dustbin. I'm again using this word colloquially to make you understand. So in 2A, eligible credit, ineligible credit, credit not available, credit partially disallowed, credit to be reversed, credit not allowed, credit entitled, credit disentitled. All credits will be lying in 2A. Everything will be lying. So from the 2A, you have to pick and choose the credit which is eligible. Only eligible credit will enter the credit channel. Eligible credit. Ineligible credit will get disqualified right at 2A stage. You have to reverse it there. You have to reverse it there. You can't claim. You cannot claim at all. To take it to 3B, there will be a mismatch between 2A and 3B. If you take the entire credit, you have to reverse it on a month-on-month basis. You have to reverse on a month-on-month basis. At some point in time, 2A must be left only with reconciliation items. Currently, you are going to avail input tax credit. As at the end of the month, ineligible credit should get reversed on a month-on-month after you take it in 3 weeks. Therefore, impossible conditions are required to be fulfilled by a recipient. But we can't help. This is the GST law. This is the GST law. You cannot say, sir, it is lying in 2A, what can I do? You have to take it and reverse it. You take it and reverse it as ineligible, not eligible, not partially reversed, fully reversed, not entitled, disentitled, credit cannot be taken. All those you will have to reverse. Right from motor vehicles which you purchase to ineligible credits like samples and gifts will be lying there. You will have to reverse all these credits. There is no other option that you have. Credit not taken by 31st March is lost forever. It is lost forever. Next, ineligible credits clearly listed in section 17 subsection 5. Ineligible credits are clearly listed in 17 subsection 5. Credits are blocked even though inward supplies are used in business. Credit taken is liable for reversal with interest. Credit is blocked even though inward supplies are used in business. They become ineligible supplies under section 17 subsection 5. Those of you who are talking of work contract services, etc., I am not getting into that litigation. If you avail ineligible credit, be careful. Under 50 subsection 3, your rate of interest will be 24% and it will not be 18%. Be careful. Proportionate reversals to be done monthly basis. But the challenge is to identify common credits. This is exactly what I was telling you when we talked of hotel expenditure, where we looked at a bar scenario, where common credits are to be reversed on a monthly basis. It's very highly challenging. Now, identification of common credits is extremely difficult in case of ineligible credits. Those of you who have questions, I will answer. Otherwise, I will not be in a position to finish my paper. Provisional credits. Provisional credits. Now, what is provisional credit? Credit is taken provisionally. Now, credit is answerable to all compliance conditions and end use. I am making it absolutely clear that credit is answerable to end use. Now, let me give you one example here. Take, for example, a Baskin Robbins. A Baskin Robbins. Or you take, for example, a sweet stall. A sweet stall. Input tax credit is taken provisionally. Input tax credit is taken provisionally on a month-on-month basis. Now, credit is answerable to compliance. When you go to a Baskin Robbins ice cream parlor or when you go to a sweet stall, the man behind the counter will tell you, sir, you taste this, madam, you taste this, sir, you taste this laddu, you taste this gulab jamun, he will tell you all of it. Now, if you are booking those transactions as samples, you will have to reverse input tax credit. If you are not identifying those transactions at all, then it is a bigger headache. We will come to it later. If you are not looking at transactions in respect of sweetmeat stalls and ice cream parlors as goods which are lost, because some of it cannot be sold, it will become stale. You have to reverse pro rata input tax credit as goods which are lost. Goods which are lost. So you will have to take care of reversal of samples. Now those are cases of sample. Physician samples not meant for sale is not a sample. That is in the course and furtherance of business. So please be very careful when you are going to identify these transactions as sample. Samples can also be in respect of FMCG goods which are manufactured, where from every batch, 3, 4, 5 items are taken out, sent to FSSAI, for example, for testing, sent for batch testing, etc. So you have to be very careful of the description or the word sample, how it is used. My suggestion would be chartered accountants are required to address this transaction right in the beginning. Right in the beginning, identify these transactions, pass appropriate entries in the books of accounts. If you don't pass entries in the books of accounts, credit can get impacted. That is why I said end use is very crucial in respect of such transactions, not in respect of all transactions. In respect of the transactions which I mentioned, end use becomes crucial. Take for example, a distributor of FMCG purchases 100 bags of I don't know, let me say cashew nut, 100 kgs of cashew nut. If 1 kg is using it as sample, it has to be identified as sample and input tax should be correspondingly reversed. If you don't identify this, you are open for estimation. End use deviation attracts reversal, because you are availing input tax credit based on your intention to use in the course or furtherance of business. And finally, if it is not used, in the course or furtherance, and if it is a sample where there is a specific input tax restriction, then it is not intended to be used. Therefore, credit needs to be reversed. Therefore, 2A will give you such examples. I've just given some examples. Please look at it. Maintain detailed information of credits taken. Maintain detailed information. When I say detailed information, please look at Rule 46. Whatever is that, your columnar form, you will have to maintain the transactions for the purpose of credit. Now, this issue we have already discussed. Credit belongs to the month in which it is taken. We have already discussed this issue of what credit taking means. It belongs to the month in which this credit is taken. Invoice in previous year, taken in current year, credit will remain in current year. That means what? You have an invoice in the month of March 2021. Invoice is in March, but you have taken the credit in 3B in April 2021. Credit will remain in April. Accounting will happen in March. Accounting will happen in March. The difference will lie in 2A. Difference will lie in 2A. Please be extremely careful of what I am telling you. I am repeating again. Invoice is March. Goods are received in April. Credit can be taken in April. Credit will remain in April. Invoice will get accounted as goods in transit in the month of March 2021. Therefore, that will lie as a reconciliation item between balance sheet and 3B. You will have to make this clear. So you will have to link the supplier's invoice with the credit conditions. This becomes crucial. If I am somebody that as a commissioner I want to harass you, I will tell you, link the credits to your credit policy. Now, what is credit policy? Infosys has a credit policy where it says, I will not take input tax credit till I effect payment to the supplier. Because tomorrow you will come back and tell me, answer section 16 subsection 2 proviso to say whether you have effected payment within 180 days. I don't want that headache. I will take the credit whenever I effect payment. What Infosys does is, in respect of transactions that are as at March 31st, 2021, they will account all of these transactions in the books of accounts and take the credit in the month of September. Take the credit. By September, they would have effected payments. Because if they don't take the credit in the month of September, credit is lost forever. Therefore, they don't want to get into that situation. Whereas in April 2020, if he has effected a purchase, not effected payment till today, he would not have taken the credit, because time limit for availment of credit is there till September 2021. For April, he has, for example, 18 months, May he has 17 months, June he has 16 months, but for the month of March he has only 6 months. So that is how they maintain accounts. Their SAP takes, their ERP takes care of this situation. So we have to be extremely careful in respect of this credit availment and credit transactions. Credit taken in current year cannot be utilized in previous year. Now these are 17, 18, 18, 19 transactions where credit relates to the current year. You cannot take credit for the previous year. Now this example I already gave you in Panarak's case, when he is filing returns for 2 months, liability stays in the month in which supply takes place, credit remains in the month in which you take the credit. You cannot say I'm filing returns for 2 months and I will adjust the input tax credit of April when I file the return in May for March and April turnovers together. You cannot avail input tax credit. Therefore, credit will remain in the month in which it is there. There is a bar and suo motu adjustment. We already talked about this transaction. Credit lying in accounts cannot be taken. Cash lying cannot be adjusted. You will have to go for a 54 refund unless it is a payment in respect of a particular liability. You cannot set it off directly. Now, credit correction. If I have to start the slide, it will take me at least 10 minutes in respect of credit correction. Panarak sir, should we break
Yes,
at this point in time?
Yes, yes, sir. Yes, sir. 10 minutes,
Yes,
sir.
we will break at this point in time. I will over to you.
6:45 will be back, sir.
Yes, 6:45. Till then, I am on mute. I have some water to drink. I will come
Yeah,
back
that's what
6:43. I will
I drank water twice, sir. You did not take. That's why I am feeling guilty.
Thank you so much. Thank you.
Please, sir.
Sir, you can unmute yourself, sir. You're muted still. Right below the.
Sir, sir,
Yeah, it's visible, sir. I can see you and it's visible, sir. You can start, sir.
screen is also fully visible, right?
Yes, yes, visible, sir. Yes, visible, sir. Yeah. You can just click
Screen
on the
is also-
PPT, so you'll be visible. Yeah.
1 minute. I have to click. Yes.
Yeah.
Now, can we start? Do we have to wait?
Yes, sir.
Time out?
Yes, almost time, sir. 6:45. You can start, sir.
Right, right. Panrat sir, I'm starting with your permission.
Yes, sir. Most welcome.
Thank you. Thank you. 6:45 and it's 6:45 already. Yes. Thank you so much. Now, we are talking of credit correction. Let's warm up for 1 or 2 minutes before we look at what this provision relating to credit correction means. I also have to give you 1 or 2 examples of what is going on definitely in Karnataka, but outside of Karnataka, I'm sure similar issues will be raging controversy. I'm fairly certain about credit related matters. Now, some of the questions that most chartered accountants or practitioners ask me when I take these sessions relating to input tax creditors, sir, how does one identify fake invoices? How does one identify fake invoices? There is no thumb rule. Even if I ask Panarat sir, if I ask a forensic auditor, if I ask for a seasoned chartered accountant who does only fraud audit like Chetan Dalal, etc., he may have no ready-made answer. He may have no ready-made answer. But let me give you some of the techniques to identify this fake invoices or fraudulent invoices. Normally, in respect of fake or fraudulent invoices, payment happens prior to the date of receipt of invoice. That means first there will be a check or DD that is issued. Invoice will come subsequently. Invoice will come subsequently. There are 2 things that will happen. Either the DD will be for the exact amount or check will be for the exact amount, or alternatively, there will be a fixed percentage which the DD or check is lower, or alternatively, the invoice value is lower, which means it is a pointer to a fake invoice. It need not be a fake invoice. It is a pointer to a fake invoice. That is all I can tell you. This is method number 1. Method number 2 is unusual transactions. In the month in which there is an outward supply, if you look at the pattern of inward supplies of this particular entity for the past few months, suddenly there will be a spurt in inward supplies. So you can look at these transactions to figure out whether some of these invoices are fake. There is a perfect possibility that I've also come across where invoices are received this month. Input tax credit is availed. Then credit note is raised in the subsequent month. This is basically to accommodate the input tax credit for cash requirement of a dealer. Be extremely careful in that cases. Invoice is received from the supplier in this month. Credit is taken in this particular month. Set off against output tax payable by the assessee. Subsequent month, because his normal purchases comes in, credit would become available. There will be a credit note that will be issued in respect of the past purchases for the full value. Please look at these transactions clearly with an open eye and an open mindset. You will be in a position to identify some of these fake invoices. Of course, it involves some time. It involves some effort. Once you get hold of these transactions, then I'm certain as chartered accountants, you know how you will have to deal with these transactions. So these are 1 or 2 small tips that I had to give you in respect of fake invoices. Now let us look at credit correction. The simple statement that you have to remember is past liability cannot be paid out of future credits. Past liability cannot be paid out of future credits. Law does not allow you. Future credit will remain in future. Past liability will remain a past liability only. Shortfall in tax payment should be paid through cash only. Shortfall in payment through cash only. Therefore, you have to generate a DRC 03. Even though DRC 03 allows appropriation of credit out of the ledger. You have to pay past credits only through past payments. Interest payments to be paid only through cash. Interest payments are to be paid only through cash. System may allow you. Be careful. But there is no mechanism for set off. System will allow you to set off the credit, but you really cannot set it off. You have to pay through cash. Interest on net tax is still not notified. Interest on net tax is not notified, now notified. That it is only on net tax. Please, sorry, it is not still not notified. It is notified. There is an error there. Please look at it carefully. It is notified. It is only on net tax. Now, this reverse charge mechanism, there have been opinions doing rounds. Opinions doing rounds. I have seen several reverse charge opinions in respect of past liabilities where many of them chartered accountants, some of them senior tax practitioners, some of them advocates have made statements in these WhatsApp groups, which I've been closely watching, saying that you please take credit in the month in which you effect payment. That means for 1920 financial year, if you are making payment in respect of reverse charge on certain service transactions where you are required to pay, or in respect of certain goods transactions where you are required to pay reverse charge, if you are going to pay, you are not paid in that month, but you pay now and take credit after the period is over. For instance, 1819 reverse charge, if you are going to pay now, or even 1920 reverse charge, if you are going to pay now, no credit will be available, because for the purpose of availment of credit for the financial year 1920, September 30th was the last date, of course, along with October return. Now, for 1920, if you have identified in January 2021, because you went through the 9C or audit process in January, you identify, if somebody has told you take input tax credit, I am afraid you cannot. This is because, please look at the provisions of 31(3)(f), section 31 subsection 3 clause F. What does section 31 subsection 3 clause F says? Section 31 subsection 3 clause F says, in respect of reverse charge mechanism, an invoice is required to be raised on the date on which you receive the goods or make the payment, whichever is earlier. So if that is the situation, in the month in which you receive the goods or the month in which you receive the service from an unregistered person or a person who is required to register but not registered, you are required to pay tax in that month. If you are paid in that month, you can take credit in that month only. Therefore, you can't pay now and take credit, because invoice is required to be raised in that month. That is the only difficulty you have. There are some child accountants and tax practitioners who said you have to interpret that law by saying in the month in which you are raising the invoice. No, it says in the month in which you have received the goods or received the service. That is the month in which you have to raise the invoice. If the invoice is raised in that month, automatically credit is gone, because prior to 30th September, you will have to avail this input tax credit. So be very careful in respect of these issues relating to input tax credit. Now, let us look at some of these rectification of errors, etc. Now, child accountants believe, many of them, not all, believe that everything should reconcile. In fact, if you ask me, I will say nothing should reconcile. I'm sorry, nothing should match, but not everything should reconcile. Some of it will not reconcile. So no difficulty. What is the difficulty? I don't find any difficulty. If everything tallies, then I have a problem. I have a problem. If everything matches, if inward supply matches with 3B, inward supply matches with financial statement, outward supply matches with financial statement, credit note matches, everything matches, there is a problem. Then you are maintaining books on not in a manner required under the GST laws. Because under GST law, there are several things that should remain unreconciled. Now, these unreconciled items are desirable because it may reconcile only in the subsequent year. It may reconcile only in the subsequent year. Take, for example, in notes to accounts and connecting statements, if a statement is made saying revenue is recognized on dispatch of goods For the purpose of 3B, you would have already recorded the turnover. But for the purpose of financial statements, you will take it only in the next year. In this year financial statements, it will not tally, it won't match, but it will be a reconciliation item. Not everything should reconcile also. Therefore, 3B will not reconcile with financial statements in this example, but 3B will reconcile with 1. 3B will reconcile with 1. When you do a reconciliation statement, I'm sorry, 3B will match with 1. If you do a reconciliation, then everything will match. Unreconciled items are desirable. They are desirable and they are inherent. It will be there due to variance in accounting. For example, annual maintenance contract, input tax credit claimed by Panarat sir in our example will not perhaps match as paid by Panarat sir will perhaps not match with the input tax credit taken by the recipient or availed by the recipient or claimed by the recipient. It will not match. So it should not match. If it matches, we have a problem. 2A should not match between supplier and the recipient. There should be some unreconciled portion of difference in credits. It can lie in 2A. It can lie in 2A. But at some point in time, it has to reconcile. GSTR 9 is a window to the taxpayer, and 9C checks if everything is explained. All that your 9C does is whether everything is explained. For those of you who are chartered accountants who are looking by saying that 9C has already been removed, what are you talking? This entire 9C is only going to remain in the statute book with self-certification by the assessee. You are not going to say that form will continue to remain in the statute book. It will be self-certified by the assessee. So 9C will remain. Assessee himself will fill up that form and he will continue to file his 9C. You don't need to do anything. Everybody is required to understand the newness in the law. If you don't understand the newness in the law, life becomes extremely difficult. So you are required to understand the newness in the law, and at some point in time, you will have to realize that this law is a question of reconciliation and this law is not a question of tallying. So this is insofar as some of the critical issues in respect of input tax credit is concerned. Now, having got all of these examples, now let us start looking at some of these transactions clearly from a legal perspective. Now I will take you through the legal position insofar as GST is concerned. Now, we use this denial and input tax restriction. We look at GST input tax denial and input tax restriction because the rule and the section will say input tax credit will be denied in certain circumstances. Now, what is denial and what is restriction? Now, denial means it is a statement that something is not true. That means you are not entitled to input tax credit. I refuse to give you input tax credit. I will refuse to allow you credit, etc. So the act of denying or refusing is actually contradiction. That means it will tell you take it and then it will deny. Therefore, be extremely careful. Denial means it is an act of refusing, whereas restriction means it covers prohibition. It will cover. I deny permission. I deny permission. That means I'm refusing to give you permission. But I restrict entry. I will restrict entry. That means you come inside the compound wall, but you don't enter the conference hall. You can come inside the compound wall. If I deny you permission to enter, then you cannot enter the compound wall itself. So be very careful that there is a limit, there is a boundary. Now, all these 2 subsection 59, 2 subsection 60 we know. These are the basics that you need to know in respect of input, input service, input tax credits, input distributor, and registered person means. Now, this conditions relating to eligibility, I've already discussed when we are talking of all of these provisions under the goods and service tax law. So we have substantially covered these transactions insofar as this understanding of these statutory provisions are concerned. So let us move on. The relevant rules are also stated here. Now when this PowerPoint comes to you by way of email, please go and have a look at it because I'm presuming that all of you will know. I will spend 1 minute on this definition clause relating to section 16(1). I'm not calling it as definition clause. I will call it a charging clause in respect of input tax credit. Charging section is 9, but charging clause for the charging subsection for the purpose of ITC. Look at how this section is worded. Every registered person shall. It doesn't talk of may. The section uses the word shall. It says subject to such conditions and restrictions as may be prescribed. Look at the word may there. It says registered person shall, subject to conditions and restrictions as may. So even if it is not prescribed, something can be imported. This is my belief. Now, senior chartered accountants and tax practitioners will tell you, you cannot import something more than what the section seeks to do. That means real-time tax practitioners will tell you, tail cannot wag more than the head. That means they will tell you, act is supreme, rules are subservient to the act, then the process, that is the forms, etc., are only procedural. Now here, look at how this section is. Section says registered person shall, subject to the conditions and restrictions as may be prescribed. So it says only conditions and restrictions for this input tax credit I may, but I can look at it completely differently also, and in the manner specified in section 49. And the manner, that means he is telling you how you are entitled to avail this credit in 49. Now he says only then you shall be entitled to take credit of input tax. You are entitled. Section 16 talks of entitlement. You are entitled to 10 days casual leave. You are entitled to it. But you can avail only when your principal allows you to avail. You are entitled to 10 days. Nobody stops you. You are entitled to credit. Only when your boss allows you to avail, you can avail that casual leave. Same way here, you are entitled to claim the credit, but only when the act and the rules permit you to avail it, you can avail. So section 16 is only an entitlement section, right? It is an entitlement section. You are entitled to take the credit of input tax charged on any supply. Be careful. A charge is on supply. A levy can be on a transaction. A charge is on supply of goods or services of both to him, which are used or intended. Please use that word. Look at that. Which are used or intended to be used in the course or furtherance of business. Used in the course or furtherance of business. Now you look at the examples that we took off. Sample. Whether it is in the course or furtherance of business, answer is yes. But there is a specific denial of input tax credit under section 17, subsection 5. In respect of sample, in respect of gift, in respect of capital assets which involve construction activity, there is a denial of input tax credit. Therefore, while there is an entitlement under section 16, there is a denial. Input tax credit cannot be availed. It says shall not be availed under section 17. Therefore, permission is lost. Here there is an entitlement. There is a denial for availment, which are used in the course or furtherance of business. So you look at sample, you look at business promotion, you look at gift, you look at loss. If it is lost, input tax credit is gone. So the sample input tax credit is gone. I am distinguishing a physician sample from a sample which is given in Baskin-Robbins. A physician sample in the case of a pharma company is in the course or furtherance of business, whereas the sample given in Baskin-Robbins is a business promotion. So how you pass the entry in the books of accounts becomes critical. It becomes crucial for the purpose of claim and availment of input tax credit. So it is in the course or furtherance of business is what a chartered accountant is required to decide when he passes the entry in the books of account. So when we pass the entry in the books of account, we have to go back to our roots and find out what is the appropriate head of account. Don't go by pre-designed, pre-assigned heads of accounts that are given by these accounting packages. Don't get misled by that. I want you to apply your mind when you pass the entry, because credit hinges on application of mind at that point in time. Therefore, when you are looking at input tax credit, section 16 talks of entitlement. It should be used in the course or furtherance of business. If it is not used in the course or furtherance of business, where the intention may be there, but end use is different. Input tax credit will continue to get reversed under section 16. Now look at these conditions that are stated here. There are 4 conditions that are stated there in the boxes that you will see. Possession of tax invoice, receipt of goods or services or both, taxes charged and supply has been paid to the government, return has been furnished under section 39. Now, those of you child accountants who want to fight with me on annual maintenance contracts, this is the eligibility conditions under section 16. Please tell me, in respect of annual maintenance contract, where is the receipt of goods or where is the receipt of service? In respect of companies which supply annual maintenance contract service, they will show the monies received as a liability in the balance sheet. They will show it as advances received from customers for services to be rendered. They will show it. So in fact, the supplier himself will say, I have not rendered service. I have not rendered service. In such cases, where is the input tax credit? Because this transaction does not get mirrored. It doesn't get mirrored. Therefore, input tax credit is a question mark. Now, the Finance Bill 2021 has introduced an additional condition. What is this additional condition? He says input tax credit can be availed only when the details are furnished by the supplier in the statement of outward supplier. That means he says only when form GSTR 1 is uploaded by the supplier, input tax credit can be availed, and such details are communicated to the recipient. That means it must be uploaded in 1 and it must be seen in 2A. That means it must be done before the 10th, or 11th, whatever date that is. If the uploading is done before 10th or 11th, it will reflect in 2A of the recipient. If the uploading is done on 19th, it will not reflect in 2A of the recipient in the previous month. It will reflect in the subsequent month. Therefore, you have an additional form, 2A form and 2B form, GSTR 2A and GSTR 2B. The law says what is in 2B you can avail the credit, what is in 2A you take it in the subsequent month, what is in 2A can also be restricted credit, denied credit, credit to be reversed, credit to be blocked, etc. What is in 2B also is not straightforward. Credit can come and sit here. You will have to apply the tests of eligibility of input tax credit before you look at these transactions. Therefore, this is an additional condition. As and when it is notified, it will become operational. Lots of installments. This is a clear example for availment of input tax credit. Please go back home and read this example. You will be in a position to understand this input tax credit details. Now, in so far as eligibility and conditions for input tax credit relating to 180 days. Relating to 180 days. Let me be honest, in respect of all my clients, I have not reversed the input tax credit of this 180 days. 2 reasons for 180 days. Look at how the provision talks about. The recipient of goods or services should pay the value of supply including tax to the supplier within 180 days from the date of invoice as per Rule 37. All right, I have not paid. I have not paid. I am the recipient of goods or services. I have not paid the supplier. Now, what I will do in each of these cases where I have not effected the payment, I will write to the supplier that in terms of the telephonic discussion, I have an additional 60 days time to pay. In fact, there are purchase orders which say credit period of 210 days, 240 days, 270 days. How can you deny input tax credit to these people and tell them you should take the credit only after 180 days? Government cannot impose a restriction on the number of days. Law says credit is a vested right on fulfillment of conditions. This condition cannot come from the back door to say the transaction between the supplier and the recipient also I will control. No, not possible. Not possible. I have not reversed. I am availing input tax credit. As child accountants, you take your call whether you want to follow me and litigate or whether you don't want to follow and litigate. Now, the eligibility conditions in respect of capital goods also. Input credit cannot be taken on invoices and debit notes pertaining to the financial year after the due date of the return of September. No difficulty. Law has given you 6 months more. If it is for the month of April, you get 18 months. If it is for the month of March, you get only 6 months. Law has given you this credit. Please note this example. You will be in a position to understand it. Now, with effect from 1st of January 2021, 1st of January 2021, let me put it that way, the time limit for availing input tax credit is now reconsidered. It is now reconsidered in respect of this debit notes. It is reconsidered, and the date of the debit notes and the date of the underlying tax invoice. Now here is an example which says if date of the invoice is 5/3/2020 and the date of the debit note in respect of that transaction is 15/4, input tax credit in relation to debit note before the Finance Act would close at September 20. Here it will close in September 2021. You have time of 18 months extra. Earlier it will close in September. Now it will close in the subsequent financial year. Please note the difference in dates here. If you have any doubts, you can take it up in the question answer session. Now, documentary requirements and conditions in terms of Rule 36. Now, please come to the right hand side. On the left hand side, you will find 1. On the right hand side, you will find numeral 2, serial number 1 and serial number 2. Serial number 1, I don't think you have any difficulty. For the purpose of claiming input tax credit, you should have the invoices. Beyond that, there is nothing on the left hand column. On the right hand side, invoice should contain all the details specified in Rule 46. I want the chartered accountants who are part of this session to hold the invoice in your hand and see whether all the conditions that are stipulated in Rule 46 appears on the face of the invoice. There are 17 requirements. Please go back and look at the Rule 46. There are 17 requirements. All the 17 requirements must appear on the face of the invoice. Only if they appear on the face of the invoice, input tax credit will be available. However, there is a notification which has come that says if it is furnished in GST or 2, this whatever 7 or 8 requirements credit will be available. But if I'm a sadist, I'm a commissioner who wants to harass you, I will tell you this is only a circular, whereas that is a requirement under law. If you don't fulfill, credit will be withdrawn. I want you to pay attention to invoices that are made in Excel sheets. Many times what happens is invoices are made on Excel sheets. We failed to raise an invoice in respect of a particular transaction. We raise it on an Excel sheet by telling the invoice number as 46A or 46-1. When we do that, or 46-1, because 47 would have already been inserted. Therefore, we use this. In such of those cases, please ensure that Rule 46 is complied. Otherwise, you will have input tax credit issues. Please look at serial number 3 on the right hand side. If tax is paid by the supplier after order has been passed, that means if there is a 73 or 74 order and the supplier pays the order, because initially I'm talking of an assessment order or a determination of turnover order under 73 or 74. If an order is passed, whereas the supplier and the recipient have an arrangement, where the recipient will tell the supplier, you charge me 5%, if the assessing officer charges you 12, I will make good that 7%. However, penalty I will not pay, interest we will share 50-50. In that situation, even if the supplier issues a debit note, unfortunately, you will have no input tax credit. Credit will not be available for you in those cases. Please be very careful that credit will not be available in those cases, because you can look at this as in the provisions relating to section 75, where you will find that 73 and 74 credits will not be available. Rule 36 sub rule 4, the lesser I talk about it, the better. I don't know why they have come up with this. First they said it is 20% restriction, then they said it is 10%, now they have come up with 5%. Then the second bullet point, they say restrictions to apply only to invoices, debit notes which are required to be uploaded by the supplier but not uploaded, required to be uploaded but not uploaded. Full input tax credit is available in case of IGST paid on imports. Let me be honest, I am not wasting my time on this Rule 36 sub Rule 4. I am availing the input tax credit in toto. I am not even looking at this Rule 36 sub Rule 4 in respect of my clients, because it will be a mismatch only in respect of 1 month. At the end of the year, anyway credit will become available. So let us not waste our time. Credit will be available. Therefore, I am not wasting my time. If there is an interest, I will fight that interest subsequently. That is how I am looking at it. For Rule 36 sub Rule 4, I have given you 1 or 2 examples. Please look at this and decide how you want to go through these examples, because everything here is answered by way of that example. Next, Rule 60. Now, this is a pretty important amendment. It provides for input tax credit which is available in 2B. This 2B is a new instrument. It is a new form that has come into the statute book all of a sudden. Now, what this 2B is doing, 2A was dynamic. 2A was dynamic. That means it would get uploaded on real-time basis. It would get uploaded or updated on real-time basis. Whereas 2B is static. What 2B does, when the supplier uploads on or before the 10th or 11th or even 13th, whichever case, it will come and sit in 2B. It will come and sit in 2B. Law says that is the credit which you can take. You cannot take 2A credit. You cannot take 2A credit. Now, this is one other restriction. This is one other reconciliation item. It is a headache. It is a headache. I don't know what this government is doing and who is giving them ideas of 2A, 2B, etc. 2B, when it was originally designed, was in respect of effecting corrections by the recipient. Where the supplier has made an error, the recipient was permitted to make the correction. This 2B would go back. It would go back and come back in the form of 3, GSTR 3. Now they've done away with that. This 2B they are using for a completely different purpose. I think we have a good case to challenge this on hand. Now this 2B is a static form. The said form will not include details of TDS and TCS. What a headache. TDS and TCS it will not include. It will not include. GSTR 1 filing date becomes dynamic and monthly returns monthly returns in GSTR file should be to be filed between 12th day of that month and the subsequent day, that is 11th. Only then it will get uploaded. Please be extremely careful as the information source from where they are picking up these details relating to be additional details that are there. What is a viewing period and what is the eligibility or ineligibility. So in addition to 2A and 1, you have to continue to keep viewing 2B. Tell your supplier, boss, it has to appear in 2B, otherwise corresponding interest I will charge you. What a headache. I've given one illustration here of how this headache is going to come and haunt you. Let me not waste my time in respect of this 2B. Please look at it. But let me tell you some of the pointers that you should take note of. Ineligible input tax credit reflecting in 2B does not cover all instances. Please be careful. Ineligible ITC, it will not reflect. It will reflect all credits. Taxpayers are required to identify ineligible credits. It is just an extension of 2A. The restriction of 5% provisional credit will not be supplier wise. It is linked to total eligible input tax credit reflecting in 2B. Restriction will have to do separately. ITC reflected in 2B should be considered as follows. This is my view and subject to challenge. For suppliers filing monthly returns, all transactions in one filed on or before 11th of the subsequent month. Suppliers in this IFF method, all transactions relating on or before 13th of the subsequent month. 2B, 2B, GSTR 2B is static document. Even a single day delay in uploading will postpone the liability by 1 month. 2A can be identified handy to identify the status of 3B against specific suppliers, and the taxpayer will have to maintain year to date. YTD is year to date reconciliation between 2A, 2B and books. Horrible job. It is one horrible job. You will be wasting your time. Input tax credit for business and other purposes. Please be careful. Section 17 talks of apportionment and blocked credits. What is apportionment and blocked credits? Input tax credit for business and other purposes. What is input tax credit for business purpose and input tax credit for other purpose? I will give you an example 2 minutes later. The input tax credit relating to business alone is eligible for the purpose of input tax credit. Input tax credit attributable for other purposes, you are not entitled to claim. Now let me give you an example. Take the case of a registered person who runs a hotel or a convention center. If this hotel or convention center is used by the registered taxable person for a personal purpose, say a wedding, a convention, a personal requirement, then it is not attributable to business. Corresponding ITC you will have to reverse. Now the headache is identifying common output input tax credit. My suggestion in such cases would be better to pay output tax rather than reversing input tax, because you will get into valuation mechanism. Pay output tax, move on in life, move on in life. This generally happens in hotels, convention halls, kalyan mantaps, etc. Be very careful in respect of personal use, including in respect of FMCG, for example, television, washing machine. The proprietor, partner, or director may take it for his personal use. Be very careful. If those are not attributable for taxable transactions or taxable supplies, input tax credit will correspondingly be denied. Identify credit, reverse. Alternatively, pay tax on output tax credit if you are not able to identify, move on in life. That would be a better way of looking at these transactions. Apportionment and block credit, exempt supply to subsection 47, non-taxable supply to subsection 78, no taxable supply, but please don't read that as no taxable. Non-taxable supply means 278. We discussed this in the early part of my first session, first half of this session. Please take into example common credits in respect of hotel. That is the example I took, where one of us drink, one of us don't drink. The second example that I took was in respect of electricity supply companies, where there are taxable transactions and electricity transactions where electrical energy is outside the purview of GST law. Please be careful. You will have to take examples. You will have to take the help of Rule 42 and Rule 43 for the purpose of reversal. Exempt supply shall include additionally supplies on which recipient is liable to pay tax, all these securities, sale of land in respect of Schedule 3, etc. So even this will become exempt supply, because sale of land is Schedule 3 transaction. Outbound transactions, country to country, outside the taxable territory transactions, will also form part and parcel of reversal of common credits under the goods and service tax law. There is a very elaborate example that I have taken by applying the formulas T1, T2, T3, T4 in terms of Rule 42 sub Rule 1. Please take this example. It's a simple example. You will be able to identify. This is the headache that a chartered accountant has to undergo to compute Rule 42 sub Rule 1. It is such a headache. It is better to apportion one percentage, the proportionate percentage, and be done with it in life and move on. You will be spending more time doing this apportionment under T1, T2, T3, T4, and it will invariably come for litigation. Now, in respect of banking companies, you have an option to avail 50%, option to comply with either the provisions or reverse 50%. Most banking companies, I understand, have opted for this 50% input tax credit. Rules 42 relate specifically related to construction industry. Now, there are two reversals that one has to do. One as of 31/3/2019 by virtue of the new notifications 3/2019 to 7/2019, which came, or is it 8/2019, which came into the statute book. That you will have to take care of it separately. You will have to reverse the input tax credit in respect of construction entities and construction companies by applying the provisions of 17(1), business purpose, non-business purpose, related party transactions, etc. Now, apportionment for business and non-business purpose, be very careful. Used for commercial purposes, also non-business, whether it is residential, affordable housing, PMVAY, AWAS. Life is horrible. Life is horrible. Apportionment for construction companies is a horrible job. Now, what I have done for business and non-business purpose, there is an example that comes later which I have taken. What is for business and non-business purpose? I will come to non-business 2 minutes later. Construction companies, be very, very careful. There could be related party transactions. There could be sale to sister concerns. Allotment to sister concerns. There can be allotment of flats to employees. There can be allotment of flats to relatives. There can be allotment of flats to contractors and suppliers. Please identify those transactions very clearly at the beginning for the purpose of reversal, denial, or availment of input tax credit. Reversal, denial, or availment of input tax credit. Notification 16/2019 is very, very relevant for the purpose of construction sector. Please go through it. I don't have the time, but separate methods of respect. Rule 42 and 43 is a headache in respect of real estate transactions. You have a separate method for reversal of construction of apartments, monthly, completion certificate, occupation certificate, delayed, extended period, timelines based on the payment for the purpose of output tax credit. Reversal is to be made on carpet area and not on the value of apartments. Please be careful. Reversal is to be made based on carpet area in terms of the new notification, not on respect of value. Please don't take value. You have to reverse it based on carpet area. Credit used for taxable service should always be 0. Common credit you will have to identify as T4. Exempt supplier and total value of supply should be computed project wise. I always tell my chartered accountant friends that in one single development there can be not one but more than one project. More than one project. Because how do you identify this project? This project is how you apply to RERA for the purpose of getting the license, for getting the permission. Now in RERA, each tower can be a project. Therefore, you will have to maintain accounts project wise for the purpose of reversal of input tax credit. Now in respect of construction services, you have 17(5)(b), construction of a complex where wholly or entirely schedule 2, sorry, this is schedule 2 and not 17(5). Schedule 2, please be very careful. In schedule 2 there is class B, all of you know it, I am not wasting time. In 17(3), exempt supply includes supply of land. Therefore, when there is a sale of land, the undivided portion of land should also be considered for the purpose of reversal of common credits. For the purpose of common credits, chartered accountants, be careful. Undivided share of interest in land, mere offering the construction portion to tax will not suffice. Land portion should be considered as total turnover. For the purpose of reversal of common credit, exempt supply should be land, and that will become part and parcel of reversal of input tax credit under 42-43. Now you have apartment book before the commencement of before the issuance of completion certificate. You have commercial apartment, you have residential apartment. A commercial apartment is an apartment other than residential apartments. I am not getting into this input tax credit. Please be careful. These 3 or 4 slides will take care of the entire headache of the construction sector. It will completely take care of the construction sector. The example that I have taken in the subsequent 3 or 4 slides will take care of the entire workings that you will need. You just need to be careful. Demand raised subsequent to 1/4/2019. These are the fundas that I have taken for the purpose of taking subsequent example. Value of such apartments on which tax is paid at old rate is treated as taxable supply prior to 1/4/19. Post 1/4/2019, unbooked apartment, how you should consider. Now these are the fundamentals for the purpose of this illustration. Now I have taken residential real estate project old rate. In the new example, you will find residential real estate project new rate. Old rate construction services, you will find old rate real estate project, and similarly, you will also find in respect of new rates. So I will skip this example because these are clearly self-explanatory. I am not going to waste time because this T1, T2, T3 is only mathematics. Clearly, you will know what it is. Now, in respect of motor vehicles under section 17, restriction was applicable. Now, effective February 2019, that restriction is removed except certain exclusions. Credit will continue to remain, will be allowed. Now, this was one issue where I am completely vexed with the government. GST is such a huge issue. Look at how these notifications are issued or how the taxation is brought in. It is talking of 13% including driver, 13% excluding driver, with driver with uniform, driver without uniform. What is this we are talking? Should government even control such transactions? Credit flow must be seamless. This is what they promised us when they bought in. Look at the input tax credit. They said approved seating capacity up to 13%. What is this nonsense? Approved seating capacity. I have to fall back on the Motor Vehicles Act to find out whether in respect of a tempo traveler approved seating capacity is 13 or 14. In Aisha Mitsubishi bus, I will have to find out whether it is 12 or 22. There are buses with 12, buses with 18, tempo travelers with 10, tempo travelers with 13, capacity including with driver, without driver. What are we doing? What are we doing? There is something wrong with this government. I don't think this is what they should be spending time upon. I have frowned upon the government. This is a problem with the GST lawmakers. Not just this, it is 5% with input tax, 12% without input tax. It is leasing transaction, it is hiring transaction, it is renting transaction. Why create this confusion? It is with driver, without driver, with input tax, without input tax, hiring, renting, leasing, capacity, approved capacity, with fuel, without fuel, no toll, with toll, without toll, rate per kilometer, contracted price. What is the government doing? I don't know why they are getting into complications. Anyway, this is the restriction insofar as input tax is concerned. In all other cases, input tax credit will be allowed in terms of section 17. In respect of repairs and maintenance services, post February 2019, credit will continue to be available to you. Pre-2019 input tax credit, you have an issue, but I have claimed saying that when the main saying that the restrictions applicable in respect of the main asset will not apply in respect of maintenance and service contract. Look at this: leasing, renting, or hiring of motor vehicles. You tell me what is rent and what is hire. Do you rent a JCB with driver or do you hire a JCB with driver? Do you rent a JCB without driver or do you lease a JCB without driver? Whether renting means it is for a specific period of time or whether hiring means it is per hour including fuel. Nothing is known. They're just calling it renting, leasing, hiring, etc., etc. What is wrong with this government by using such terms and phrases? I have no idea. I'm a completely confused man. After this renting, leasing, and hiring has come in, I've lost all my confidence of when I can get subjected to the highest rate of tax. Look at this food and beverage industry. What is wrong in giving input tax credit on catering contracts or food bills? I don't see anything wrong because they have made that hotel industry liable to tax at the rate of 5%. Compulsorily without input tax credit, they are denying input tax credit here. What is wrong if an entity claims input tax credit? Because GST, when it was told to all of us, they said seamless input tax credit will be available. You have an invoice, you effected payment, avail input tax credit. Now look at the conditions that these people have come out with. Now they've gone to the extent of restricting input tax credit on clubs, health, fitness, and travel centers, etc. What is wrong? How many crores of rupees are they going to lose tax? By removing all these restrictions, the entire section 17 can get wiped out. The total money that the government may lose may probably be about 1,000 crores of input tax credit. Trust me, not more. Consciously, companies will not claim if it is meant for personal use. Proprietors and partners here and there, they may use these clubs and therefore they may avail input tax credit. I don't see anything wrong. If a fellow is going to spend, let's say, 1 lakh per annum on club, it is an expenditure. Somebody is earning revenue out of it. If 5,000 rupees, if this man is going to claim input tax credit, let him claim. At least cash expenses will come down. The expenses in book will go up. The government doesn't think that way. They want to deny input tax credit. So people pay cash and move on. Cash economy is never going to reduce. If credit was available, these industries, at least cash transactions in respect of these industries would have gotten reduced. But the government doesn't think this way. It thinks completely differently. Now, in respect of works contract service under section 17, subsection 5, 17, subsection 5, clause C and clause D. Be very careful. If any works contract service has been received towards construction of an immovable property, except in case where works contract services are received for further supply. That means a subcontractor executing services for a contractor, the contractor can avail input tax credit. When a contractor executes works contract services for a developer, developer can claim input tax credit because he is subsequently supplying the same works contract service to the customer. It stops with the customer. stops with the customer. However, if goods and services are received by a taxable person for construction of an immovable property, that means if a developer constructs a commercial complex and subsequently wants to rent it out, the law says that there is no input tax credit that will be available. The matter was a subject matter of challenge in the Safari Retreats case in Odisha High Court. The Odisha High Court said, what is wrong with this government? They just said input tax credit will be seamlessly allowed because output is a subject matter of tax. The output is rental. Rental is subject to 18%. Without these inputs, there can be no output. Therefore, the entire input tax credit used for construction will be allowed. This judgment was used. In Karnataka, we have a similar decision where a stay has been granted in the case of Bagmane Techtar, where they said 90% of input tax credit you use, 10%, which is the tax amount that you have to pay in the event you lose the appeal before this assessing officer to file a first appeal. Therefore, the court said 90% you utilize, 10% you leave it on the portal or leave it in the government account. Therefore, in Karnataka, in Bagmane Techtar's case, you have a conditional stay. 90% can be utilized, 10% cannot be utilized. That 10% would be equivalent to the tax amount in terms of section 107, which is the appeal provision. And that is how we have moved on in life. Now, in the Tarun Realtors case, it is a very important advance ruling. Karnataka is always in the forefront of litigation. Tarun Realtors case is no exception. I understand Tarun Realtors has not moved the High Court because this order of the advance ruling authority is by the appellate authority for advance ruling. So they have lost the assessing authority level. Now they have lost at the appellate authority level. They have stopped. They have not moved further. They have not gone to the High Court. So this advance ruling will be used by all states. Now here, look at this condition. What the appellate authority says in respect of chiller, air handling, etc., used for construction of the immovable property. Now he says, such in this advance ruling in sum and substance, such of those goods which are used for the purpose of construction of an immovable property, without which you will not get an occupancy or possession certificate, are immovable in nature. Now, firefighting equipments, chillers, air handling units are all part of the plan. Once they become part of the transaction, they become part of the building for obtaining occupation certificate. Therefore, the government said you will not be entitled to input tax credit. In respect of the others, they said you are entitled to input tax credit. You are entitled to input tax credit, but if they are specifically excluded from plant and machinery, then they are not entitled to input tax credit, because they said DG set and transformer also become part and parcel of the immovable property. I don't understand what is wrong with this advance ruling. Input tax credit is not available in respect of composition, non-residential unit, personal consumption in terms of section 17, lost, stolen, destroyed or written off. Be careful. Lost, stolen, destroyed. Chennai floods, Kerala floods, Koshi floods in Bihar, Uttarakhand, we had a huge destruction of national thermal power plant. If they are entitled to input tax credit, it will be gone. You will have to reverse it. You have to reverse input tax credit to be blocked or reversed when goods are given by way of gifts or samples. When erroneous refund credits are not available. These are section 17. Now there are some circulars that are issued here in respect of free samples and gifts. Samples supplied free of cost or gift does not qualify for input tax credit. However, the input tax credits on capital goods used in relation to the gifts without any consideration is restricted under 17(5). I don't know what this government is doing. They are getting into nuts and bolts. They are not looking at the components, assemblies and sub-assemblies. They are getting into nuts and bolts to find out how it is taxable or not taxable. Buy one, get one offer. Look at the circular that has come in respect of buy one, get one. They shall be dependent on whether it is a composite supply or mixed supply. Where is buy one, get one offer, a composite supply or a mixed supply? He is telling I'm giving you two. That's all for one single price. Whichever is the primary supply, that is the price at which you will have to charge tax. If I tell you buy one bucket I will give you a mug along with it free. So it's a buy one get one offer. The price of the bucket will be the rate of the bucket will be the rate at which you will have to pay for mug also. So I don't understand what they are doing. This circular in respect of discounts that they gave, they withdrew this at a subsequent point in time. Therefore, here is a clear case where a circular was issued. Government did not know what to do, how to handle this business related matter. Therefore, without applying their mind, they have left it to hundreds of assessing officers across India. Each one will come up with a PhD now and levy tax or grant exemption, depending upon how well you take care of this man during the assessment proceedings. Now, all these free samples, buy one get one offer, only taxable, I completely discussed with you in the first part of my session. I will not waste my time. Availability of credit under special circumstances. Now, this is up to the date of registration, voluntary registration. When you cease to pay tax under composition scheme, how you should avail the input tax credit is section 18 subsection 1 to 18 subsection 6 are captured in the next 4 or 5 slides. There's absolutely no difficulty. It is straightforward law. Let me not waste my time in respect of this section 18. These are simple PowerPoint presentations. When SIRC of ICAI sends you this email, you will be able to figure out how this has been taken care of. The only point that I will look at is exempt supply to taxable supply. Be very careful here. Please look at the box. In all the above cases, registered person is eligible to take input tax credit. When my exempt supply gets converted to taxable supply, the value of goods in stock, I'm entitled to take input tax credit on the date on which it becomes a taxable supply. On the date on which an exempt supply is notified as a taxable supply, I'm entitled to avail the entire input tax credit. Now we are looking at this 6 or 7 transactions. When there is a change in constitution, sale, merger, demerger, amalgamation, etc., input tax credit will be remained. Input tax remain unutilized in the books will be transferred. It will be transferred. It will get transferred to the transfer. Some of the conditions that are there insofar as this transferor is concerned is stated here. You have to file a request in 02. Child accountant certificate is required if it is in excess of 2 lakhs. Transfer will accept the details. Credit will be available. So these are very simple transactions. I don't see any difficulty at all. Same section 18 also talks of a shift from composition to exemption. The exemption to composition, composition to regular tax, etc. No difficulty. These are absolutely simple transactions. The manner of reversal under 44 is something which I thought I should take by way of an example. So in this example, from regular scheme to composition scheme, I have taken an example which is a very complex example. If you are able to understand this example, I think you will be in a position to tackle section 18 completely. I don't see any difficulty at all. So please go back home, spend some time on understanding the transaction, and I have taken numbers here. I don't think there is any rocket science in what is there. I am not seeing any difficulty at all. Next, the amount payable in case of supply of capital goods and plant and machinery, where we are talking of 5% as basis points for every quarter. The government has assumed that you have 20%, therefore a capital goods life is 5 years. Therefore, you will have to apply this 20% theory that if you have claimed input tax credit on capital goods and sold it in year 3, then you will have to retain 60% of input tax credit, 40% you will have to reverse based on this 5% per quarter theory. Input tax credit for job work, please look at section 19, read it with 143, simple conditions relating to inputs and inputs, where in respect of capital goods, if it doesn't come back within a period of 3 years, or in respect of inputs within a period of 1 year, input tax credit will stand restricted and output tax will become payable. There's absolutely no difficulty in understanding this provision at all. Resident welfare associations, at last some relief for these gentlemen, 7,500 we know, we are clear. We thought that this Calcutta High Court decision will save this resident welfare, Supreme Court in the Calcutta Clubs case. Now they have gotten a retrospective amendment from 1/7/2017. God help this resident welfare association and other clubs. Some of these issues that I've taken here, I think most of these issues I have answered while I was taking care of the slides itself. So one of you can take lead here to figure out whether I have not answered any of these questions. If I have not answered, please point it out. I will answer. But to my belief, I think I've answered all the issues that I've taken here during the course of my discussion itself. I don't see any issue that I have left unanswered. The only issue that I can look at is in this final bullet point. Please go to bullet point number 3. In respect of hotels, where there is wastage of food, complimentary food for staff and guests, complimentary airport draft, or drops free room to staff and others. How do you reverse the input tax credit? It is a headache. My suggestion is have a policy for this reverse input tax credit. If the government has to challenge, they have to come up with a completely different method. So I suggest for wastage of food, please reverse input tax rate on say 1,000 rupees per day on an estimated basis. It's an estimate. Let them come out and say how much we have wasted. Let us see. Similarly, for complimentary food to staff and guests, apply a value of 50 rupees, matter close. Consideration becomes the transaction value because they are not related parties. Guests are not related parties. For staff, anyway, they are not going to get the buffet that you get. For them, it is going to be sambar, rasam, and 2 chapatis. So you price it at 20 rupees and pay your tax on that, so that there is no headache of reversal in all of these cases. The last 2 questions. What if ITC avail does not match with books of accounts and portal? All that you need to do is prepare a reconciliation statement and reconcile the same. As I said earlier at the end of the first session, if everything matches, I have a problem. Everything should reconcile. Everything need not match. How does one avail input tax credit if invoice is inclusive of tax? Please look at Rule 35. Rule 35 says if the invoice does not reflect the value, but the invoice states that it is inclusive of tax, you need to look at the HSN, arrive at the rate of tax, and you will have to do, if the rate of tax is say 12%, you will have to do 12 by 112 and avail input tax credit. Even if the invoice is inclusive of tax, you look at GSTR 1, which is uploaded by the supplier. If it is uploaded by the supplier and whatever is the tax amount that is appearing in 2A, that is the tax that he has collected. That is the tax that you will be entitled to for the purpose of availment or entitlement of input tax credit. Thank you, ladies and gentlemen. Thank you, SIRC of ICAI. Thank you, Chairman Jalapati sir. Thank you, Kamarad sir. I know I was a little fast. I could have gone a little slower, but I could not have lifted the tempo of the discussions the way I wanted to speak about input tax credit. Let me be absolutely clear. I have not still covered about clearly, concisely, or precisely in respect of certain classes of businesses. I have not had the time to get into those transactions. For instance, in respect of real estate business, in respect of leasing entities, in respect of hiring entities, in respect of pharma companies, or in respect of FMCG, the methodology of allocation of common costs is something which I always love to discuss upon. I will give you one example and you can think about it and move on. Take for example Unilever. Let us say Unilever has got a 3,000 crore advertisement budget, 3,000 crores. And that 3,000 crore advertisement budget, let's assume, is spent in Bangalore. Now, how is this cross charge going to take place? There will be print media, advertisement through print, advertisement digitally, advertisement on cloud, advertisement electronically, advertisement by hand, advertisement by way of holdings, advertisement by way of paintings, advertisement by way of paintings on houses, advertisement on transport vehicles. How is this input tax credit? Whether it should be taken based on products, whether it should be taken based on products sold in that state, and whether it should be sold on product manufactured and stock transferred, whether it should be based on number of factories, whether it should be based on number of distributors, whether it should be based on the TRP viewership, is something which you will have to be very careful. However you do it, if I am the commissioner, I can come up with something else and say you are not entitled to these credits. Ladies and gentlemen, this is one example. So input tax credit is a never-ending topic. That is why when Jalapati sir said how much time you need, I said, sir, you give me 1 day. Whatever is left over, I will take it on the subsequent day. So you've seen 3 hours is insufficient. It is not enough. I had to pick up pace. I am aware, my apologies if I have spoken at a very brisk pace, but I believe that because we are chartered accountants, we would have kept the tempo up because we know the provisions relating to the goods and service tax law. I had to move it up. Thank you. I'm now open to questions. Panarat sir or Selva sir, if you can put up the questions, I'll start answering the questions. Yes. Question number 1. A dealer has input tax credit as per purchases. No difficulty. The suppliers who are registered as regular dealers are not filing the returns, hence not able to avail input tax credit. Is there any option? Venkat sir, you share my name. So Venkat sir, in this case, please avail the input tax credit. Please avail the registered dealer as input tax credit as per purchase. Suppliers are not filing the returns. You please avail the input tax credit. I am sure at some point in time, this section 16 will be read down. Arise India's case, Supreme Court, where under the VAT law, the Supreme Court said, why are you denying the benefit of input tax credit to the recipient or the purchaser? You have to go after the supplier. But Venkat sir, what you will have to be careful is whether the recipient has paid to the supplier, including the tax amount. If the recipient has paid to the supplier, including tax amount, you are entitled to input tax credit. A CS certificate will suffice. Take a CS certificate, move ahead, claim the credit. At some point in time, law will get settled. Question number 2. A dealer purchases from outside the state. No difficulty. All their sales are within the state. No difficulty. So IGST is the input tax credit. Outward supplies would be CGST, SGST. Input tax credit under IGST is accumulated. Yes. The same is reflected as CGST in subsequent months. Though there is input credit available, dealer has to make payment to discharge SGST. Is there any option? Sir, the only option that I can think of in this case is because of the new credit rules and amendment to 49. Please file a writ petition in the High Court. That is what I said. There is one section which gives the credit. There are 9 sections which take away the credit. Therefore, go to the High Court. I am 100% sure you will succeed. Third, whether GST on capital goods, laptops, air conditioners, cars can be availed. Input tax credit for service providers like CAs and lawyers. If you are a CA, lawyer or a doctor, laptop credit available, air conditioner credit available, motor vehicles specifically restricted in terms of section 17, credit not available. Capital goods. What are your capital goods? Furnitures and fixtures, chairs, electrical goods like fans, printers, you will be entitled to input tax credit. Next, in maritime industry, a foreign company having its project office in New Delhi, project office having its project office in New Delhi, its offshore support vessels working in Mumbai port, they hold Delhi registration. It procures material from Mumbai supplier for the operation of the vessel. Supplier raises invoice with CGST, SGST as they provide services in Mumbai. Whether the project office can avail input tax credit, I am unfortunate, Salin Tanamani sir, you cannot avail. CGST and SGST credit stays in the state where it is. My suggestion would be you cross-charge. See, what happens is the project office in Delhi will be rendering some services to the port in Mumbai. So what I am saying is that the port in Mumbai raise an invoice for cross-charge on New Delhi office. Use that SGST and CGST credit. Supplier raises invoices with IGST based on project office. Can the project office avail? No, wrong. Supplier cannot avail because a registration is required in Mumbai in your case. It has to be CGST, SGST. If it is IGST and I am the commissioner, I will deny input tax credit for you. Next, question 5. Next, please let us know the time limit for issuance of credit note as per GST Act and corresponding reversal of ITC. If you are talking of credit note in terms of section 34, it is 6 months from the end of the year. Matter closes. Beyond that, you cannot issue credit note. In case input tax credit has been availed but not utilized, you have availed input tax but not utilized, would there be any interest liability on such reversal of credit? Reverse now. Fight the reversal. Absolutely no difficulty at all. The only thing, Haridasan sir, you will have to demonstrate is that so much of credit existed on the portal month after month. Be very careful. Look at your question. Input tax credit is availed. The moment you avail, it will go and sit as credit in the portal, right? But you have not set it off against any liability. Therefore, that much credit should always be available. To the extent of reversal, if it is on the portal, no need of payment of any interest. No need, because interest will only be on cash payment of tax and not in respect of reversal. Next, when collection of whether collection of electricity charges by mall owners will constitute exempt supply. In my view, it is an exempt supply, provided it is on sub-meter basis. Sub-meter, you forget the board rates. If it is on sub-meter basis, a sub-meter is a meter within a meter. That means there is a meter at the transformer level. There is a meter to every shop owner in a mall. If you are collecting only based on the units consumed, it is Rule 33, no liability to tax, no liability to further tax. If it is treated as reimbursement, no 4243, no 4243. Falguna sir, please don't apply 42 and 43. This is a perfect reimbursement. Anyway, you would not have claimed input tax credit in respect of supply of electricity. Next, in case of petrol pumps, there is no GST agreed on petrol and motor spirits, but there is GST on lubricants, correct? Then input tax credit can be taken on proportionate basis, or how? I am suggesting to you that input tax on lubricants, please avail it in full because you will have an inward supply invoice. Now, in respect of common credits, the only option that I can see is based on turnover. So if lubricants turnover is 10 lakhs, petrol and motor spirit turnover is 90 lakhs, 10% of input tax credit you can avail. In respect of lubricant purchase, full input tax credit will be availed. Whether ITC needs to be reversed on high C sales, my answer is yes, because there are activities covered by Schedule 3. Shiva sir, it is governed by entry 7, para 7, Schedule 3. Therefore, input tax credit ought to be reversed in case of high C sales. That is what I was talking about. No supply transactions is electricity from grid and water supply to tenants, whether they are charged individually based on use as per submitters or no supply. My answer is yes, there are no supply transactions. There are no supply transactions, not liable to tax. Not liable to tax. There are no supply. Be careful. Exempt is different from no supply or non-supply. They are non-taxable transactions outside the purview of GST law. Whereas water is an exempt transaction. You have to reflect water claim exemption. Electricity outside GST law, no requirement to charge tax. Should remuneration of working partner received from LLP be considered for threshold limit of aggregate? No. Chidambaram Pillai's case. I don't know the exact citation, but I know the name. CIT versus Chidambaram Pillai. The Honorable Supreme Court said remuneration of a partner is a share of profit. Therefore, it should not be considered for the purpose of registration under GST law. Sounded, madam, I hope I have answered. From Residents Welfare Association, question number 13, whose aggregate turnover during 2021 is less than 50 lakhs. And also, one minute. Can Resident Welfare Association whose aggregate turnover during 2021 is less than 50 lakhs and also registered currently as regulate opt for payment of tax in the composition scheme under 10(2)(a)? Yes, they can opt. Absolutely no difficulty, but input tax credit will be lost. Be careful. Your cost will go higher. Your residents will eat your head. So be extremely careful when you opt for composition scheme. Your opted provides taxable as well as exempt supplies. It avails gross credit, including the inputs used in the provision of exempt service, and reverses the credit used in providing input service via 4B of GST or 3B. Okay. The ineligible credit is transferred to respective accounts and removed from GST. Perfect treatment so far. And only the net credit after reversal is available in GST accounts. Auditor's responsibility is limited to net ITC only. Right. You are right. Perfect. Whoever said this is right. GSTR 9 should be gross credit. GSTR should be the gross credit shown in table 6 and reversals be included in table 7 or show only net amount. I am saying show only net amount. Show only net amount because it doesn't enter the credit stream. Reversal is gone. Show only net amount. Arvind Ramchandran sir. Excellent. Beautiful way of passing entries. Next. Difference between, have we jumped one question, Panaraj sir? Difference between section 16. Have we jumped a question? Difference between 16.4 and 39.9. like reversal of unutilized credit in the financial year before September month of the following year. Now be very, very careful. Difference between 16.4. Reversal of unutilized credit of financial year before September and the following year. Unutilized input tax credit. Unutilized. Unutilized is different from ineligible. Please be careful. I have said ineligible input tax credit should be reversed on a month-on-month basis. I did not talk of unutilized input tax credit. Unutilized input tax credit can be carried forward for the purpose of set off against subsequent taxable supply. Ineligible input tax credit should be reversed in the month in which you treat them as ineligible transactions. I hope I'm clear. C.A. Prashant. Is there any provision other than inverted credit to claim refund? We have more credit and wanted to get refund. Ganesh, but unfortunate, there are only two transactions. One is refund is possible in case of inverted duty structure, and in the second case, when you are a zero rated supplier. In no other case, you are entitled to refund other than section 77, where you have paid the wrong tax, you pay the correct tax and claim refund, or where cash is sitting in a cash portal, cash ledger, and you want to avail input tax credit. There is no other provision relating to refund. Taxpayer has availed input tax credit belonging to 1819 in 3B of 1920 before September. In such case, in the GSTR 9 of should the taxpayer furnish such credit in table 6M of GSTR 9 or show how such credit to 6B as the no. Arvind sir, be very careful. When you are talking about GSTR 9, when you are talking of GSTR 9, you have to separate all of these transactions relating to 3D. Simply because 1819 transactions you have shown in 1920, it will not enter the 9 of 1819. 1819, the 9 of 1819 has a column which says outward supplies reflected in subsequent year or past year to be deleted. You will have to show it in that column. Next, please explain the provisions relating to input tax credit on finance lease. Is there any difference in treatment of input tax credit and finance lease? Haridasan sir, finance lease is a loan transaction. In simple terms, finance lease is a loan transaction. I think it is the Leasing Association of India versus Union of India, Supreme Court, where the larger bench of the Supreme Court said a finance lease is a loan transaction, and operating lease is a lease where there is a transfer of right to use. In a finance lease, there is no GST. In an operating lease, tax will be payable at the rate applicable to the product under lease. Sir, can we reverse input tax credit wrongly availed in 1718, or should it be settled by cash? You cannot reverse now because you utilized that credit in the subsequent year. You have to pay cash, and that cash will now carry interest. Ganapati Subramaniam sir. Dear sir, in a manufacturing company, if samples are issued for a new customer to establish relationship, does this requires reversal? Nagalakshmi madam, this is exactly what I said. How you book the entry in the books of account? Why do you want to book it as sample? I want you to book this as business promotion expenses. If you book it as business promotion expenses under the head marketing expenses, input tax credit will not get reversed. If you book it as sample, then input tax credit will be reversed. Because literally, the department goes by section 17, where they will see the word sample, they will say you reverse. They will say you reverse. But in the case of business promotion, there is no requirement to reverse. Therefore, I said an accountant's job becomes more important today because heads of account have to be dealt with correctly and completely. Question number 21. Vendor raised an invoice in 2018-19. Recipient accounted in March to 1 minute. Let me understand. Vendor raised invoice in 18-19. Recipient accounted in March 20. Okay. On receipt of invoice during March 20. Whether ITC is eligible to claim since the invoice is received in March 2020. I think for the purpose of 18-19, the last date for availment of input tax credit was April 2020 as per notification. I will stand corrected, but I think there was an extension up to March 2020. If you have accounted in March 2020, you have saved the credit. There was an extension. I think April 19th or April 20th, 2020 Up to that, you could have claimed input tax credit. Yes, I think I'm right. Sir, how can we claim input tax if the supplier files under B2C in March and not rectified even in 9? The only option you have, Panindra, is to tell the supplier to give you a CA certificate that due to inadvertence, this particular supply has been reflected as a B2C transaction, and tell him to give a reconciliation statement that out of the total output tax relating to this B2C transaction, your transaction of this 50,000 or 1 lakh or 5 lakhs is also included. Take a CA certificate, claim the input tax credit. I'm sure you will succeed. If ineligible credits are lying in 6A, which has not been transferred in 6, what are the consequences? I will tell you to reverse when I come, and I will levy a general penalty of 25,000. CA Uma Madam, I will tell you to reverse, and I will levy a general penalty of 25,000. CGST 25, SGST 25. Be careful. Next. Question number 24A. When we want to change the firm to a private limited company, how do we take credit of unutilized credit of the old entity to the new entity? The limitations, etc. What happens to input tax credit availed or the input tax goods supplied? Law takes care of this situation. The law takes care of this situation. Go to 18. 18 says input tax credit from the old entity will be transferred subject to CA certificate. I think it is 18 subsection 5. Input tax credit in special circumstances. Credit will be available. Unutilized credit in the old entity can be transferred to the new entity. If it exceeds 2 lakhs, you need a CA certificate. Take the input tax credit. Reverse in the old entity, avail in the new entity. Credit will be available. CA certificate is required within 30 days from the date of transfer. That is the limitation. If you have not taken the credit, as a special case, file a mercy petition in one of the high courts under Article 226 and then see what happens to your case. I will wish you good luck. Question B. Question B. Question B. Question B. What happens to input tax credit availed on goods supplied to SEZ units? What will happen? Input tax credit availed on goods supplied to SEZ units. How can it be? Supplies to SEZ units are zero rated. Zero rated. What happens to input tax credit availed on goods supplied to SEZ units? No difficulty. Avail it. You don't need to reverse it. No. Supplies to SEZ units are not exempt. Supplies to SEZ units are zero rated under IGST. Please be careful. 24B. Since supplies to SEZ, you have put it as exempt. No. It is not exempt. It is zero rated. It is correct. If you have claimed input tax credit, it is correct. You are entitled to input tax credit. Next, 2A versus 2B. Which is to be taken for ITC claiming? Prashant, if you don't want litigation, if you are God-fearing, you don't want to fight, go by 2B. Otherwise, take 2A. Next, RCM payable for the month of April during May. Whether ITC claim can be claimed for the month of April return or May return. I am very clear, Falgun sir, it is May return. I understand that the portal is allowing it to you to claim in the month of April. No, it is not possible. It is only on the date of payment of RCM you are entitled to input tax credit. The date of payment of RCM is 20th of May. On 20th of May you are entitled, which means it is not April month. It will be May month that will be entitled. There is a mistake in no, there is two more questions.
Sir,
Yes.
is my screen visible or
Suddenly something happened?
nothing, sir? Nothing.
Nothing. Okay. Next question. Sir, there is a mistake in 9C report. The auditor wrongly identified interest income. 1 minute. Auditor means I have to be careful. Sir, there is a mistake in 9C report. All right. So what will happen? The auditor wrongly identified interest income as not reconciled income. How to rectify? Don't rectify. Write a letter. Write a letter to your DG, to your assing officer. Matter closes there. Say there was a mistake in so and so page in so and so paragraph which was uploaded. Please read that as this matter closes. Next, credit reversal liable to interest, even if lying unutilized on net tax is still not notified. Patna High Court in commercial held that credit wrongly availed but not utilized, interest would not attract. Sundarajul sir, maybe you are right. Credit reversal liable to interest, even if lying unused interest on net tax is still not notified. I thought it is notified. Sundarajul sir, please see. Sundarajul sir, parlo notify ಆಯ್ತು. ಇಲ್ಲ ಅನ್ಸೋದ್ರಿಂದ next question regarding ITC claim. As per section 16(4), ITC of 1920 can be claimed up to September 20, correct. However, 36(4) restricts claim to the extent of 110% of matched invoice, correct. In cases supplier has uploaded the sales transactions after 20th, I'm afraid no, whoever has asked this question, I don't think you can avail input tax credit. Next question.
1 minute, sir. 1 minute.
Selva, Parno,
The last question, sir. Last question. Last
29th. Sir, purchase made from registered persons. Yes. 1 minute. Let me read that. Purchases made from registered persons are not reflected in portal in 2A and notice is issued by department. GST and specified by counterparty is wrong. How to deal with this issue, sir? Please take a CA certificate in such cases from the supplier saying GSTN number is incorrectly stated. Give them the purchase price where you will have correct GSTN number. Tell them input tax credit has been availed on the basis of invoice and not what is stated in 2A. Fight this case, we will succeed. Thank you so much, SIRC. Thank you.
Thank you, sir. We have a lot of questions flowing in. I just stopped there as of now. Parag sir. Yes, sir. I have another 10 to 15 questions flowing up. 1 minute, sir.
You want me to answer? I will answer.
No problem, sir. We'll just mail it to you. So it's almost time, almost 8:11, sir. You have been running a marathon session for another 3 hours, right? We'll take it up, sir. We'll send you the mail. We'll try to answer if possible.
Please send the mail. I will reply to it.
Sure, sir. Thank you, sir. Parag sir, you can.
Yes, sir.
Finish the question, sir. Yeah.
Sir, Venkatramani, sir, hats off to your efforts. Sir, this is the real strength of the institute. You are the real pillars of the institute. At the cost of repetition, I keep telling, you are the real assets of the institute. Not the bank balances, not the infrastructure. See, around 450, 500 people sitting across 3 hours, and your energy levels and your knowledge and all. And only one small aspect of input tax credit has so many aspects. And as you rightly said, I am really indebted to you and hats off to you for the one statement that you made. There is no dearth for what's called opportunities, even though 9C is taken off. This is the strength. This is the strength that is required for our members. And I humbly request each member, each one of you who have attended today, to upgrade yourself, even including bank audits. Please upgrade yourself. The reports are not at all encouraging the way we are reporting. And he has put in softer words. Normally, he used to be very tough earlier, but of late is nearing 60, so he has become softer. Otherwise, Venkatramani used to blast everybody, even on the stage. So these are the real assets. Their anger, anguish is only for the good of all. So thank you very much, sir, on behalf of the institute, SIRC, and we are really grateful to have you for 3 hours. 3 hours you are telling that it is not at all enough. There is so much to learn, and this has to be understood by each one of us. And I thank from the bottom of my heart for your efforts and your time, your energy and sacrifice. Thank you very much. Hats off to you. On behalf of SIRC and ICAI, sir, we keep disturbing you. We keep calling you. Please come in for us. Even for bank audits, we may develop one WhatsApp group wherein for GST issues, you may please take out your time and guide our members during the process of a bank audit also. With these requests, if any queries are there, they would any additional queries if not addressed, they would shoot the questions to your mail, and please respond to them at your free times. Thank you very much for your effort. I
Thank you so
thank
much.
each one of the delegates for your attendance in good numbers, which is really a great energy, adds to the enthusiasm of the speakers also. Thank you, and your participation gives energy for us to do good programs and number of programs. Sir, any views of yours, sir, Venkatramani, sir, before closing?
Congrats, sir. I'm impressed. There were 500 plus at one point in time. It crossed 500. 475, 480, I think, was fairly static. Wonderful.
Yes.
I think that means in input tax credit, there are so many issues which members want to know.
Yes.
My request, Panarak, sir, to
Yes, sir.
SIRC is that this input tax credit must be a full day workshop. Under your,
Yes,
if it can be considered, it should be one
Yes.
full day workshop. If it can
Yes.
be sector wise, real estate, FMCG, yes.
2 half days. 2 half days are like that. We will do, sir.
Yeah, 2 half days or something like that.
Yes.
I am
Thanks.
100% sure it will benefit everybody. So
Yes,
please
yes.
consider input tax credit is a 8 to 10 hour session. That is a time that the speaker will need.
Yes,
1
sir.
hour
2 days.
to our time. Don't even give them 1 hour.
2 days or 3 days workshop we will do, sir. We will definitely
Yes.
plan. I'll convey your message and see that that is done with
Yeah.
the discussion with our chairman and the executive committee at the earliest. Thank you very much,
Yes.
sir. Thank you.
Thank you very
sir.
much. Thanks a lot.
Thank you,
Selva sir, thank you. Selva sir, thank you so much.
Thank you. Thank you.
Technology challenge. I don't have troubled him so much. Thank you, Selva sir. Thank you,
Thank you.
Panara. Thank
Thank
you,
you,
sir.
Siddharth, and also Parmasivan sir, office, SRC office, every one of you for making this a very, very smooth sail in conducting this program today. All the EC members are otherwise busy. I am the lone person sitting on the 3 hours. You made my job very easy. Hats off to you, Mr. Selva. Thank you very much. Thank you all.
Thank you.
Good night. Thank you.
Good day.